There's a lot of cash in the economy. There's a lot of cash on balance sheets, and this cash will get deployed one way or the other.
People, they don't like inflation. This is true, but they will tolerate it.
Inflation is going to be eating into the real wages of low-income households.
Transitory gives the impression of over and done very quickly. I don't think that's what we'll see.
When we get through the noise, when we get through the supply-demand imbalance, will prices stay sticky or not? The market seems to say no.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures up 1/3 on the S&P 500. We advanced 12 points in the FX market. Dollar weakness. Tom Keene, DXY, the dollar index with an 89 handle.
Yeah, everybody frenzied up here about, the media thing and the mergers and all that, John. But I think we got to pay attention to the markets. We are really not at a range breakout, but we are at a critical point for foreign exchange. I know, John, you've been focused on stronger euro as the proxy there, but it's a lot of other places as well. It's a moment for a weaker dollar.
Well, there's the 122 handle on euro dollar, and we'll talk about the ECB pushback or the potential for it a little bit later. Got to talk about the earnings as well this morning, Tom. Walmart, Macy's, Home Depot, a lot coming up.
There's a lot coming up here. Always Home Depot is what you focus on. It's just so well run. You look at the margins there, really, John, to 100th of a percentage point, and we'll have to see what they say. Walmart, of course, with their challenges as well, particularly with an Apple equivalency there. The earnings will be great, but what it's about is a reaffirmation of this market. Look at the VIX, John, under 20, 19.43.
And when you were taking a long weekend, Lisa and I were talking about AT&T Discovery. Lisa, this morning, the focus, MGM Studios and Amazon.
Yeah, it's really amazing, the acceleration of some of the streaming consolidation. You think about how transformative last year has been with respect to how we deal with content, how much content, frankly, we absorb. And the question is whether the record pace of media deals that we see this year will be smart or perhaps will be hasty with respect to some of the changes going forward, John.
And there's the headline, Lisa, come from Home Depot. The first quarter comp sales coming in at plus 31%. The estimate 20%. That number's not too bad, Lisa, is it?
No, and it's fascinating because it really shows the haves and the have-nots from the pandemic, right? I mean, home improvement was really all the rage because everyone was staying home. And you've seen this in home builders. We're going to talk more about that in just a minute. But you continue to see certain retailers have strength. I wonder how that squares, John, with the retail numbers that we got on Friday that were highly disappointing.
EPS 386, the estimate $3.06. Net sales coming in at $37.5 billion, the estimate $34.86 billion. What have you done for me lately? A 20% gain year to date for Home Depot, I believe. 70% plus for Macy's, Tom, when we look at those numbers a little bit later this morning.
That's through the headlines. To me, John, the GDP proxy here is Home Depot, first 90 days of the year, average ticket up 10.3%, and maybe that's a proxy of a 10% boom economy.
Early days in the pre-market, we're down about 1/10%. I went through the price action to get us started this morning. Your S&P 500 advancing 15 points. We bounced back from a mild day of losses, up 1/3%.
I thought yesterday was
in the bond market, 164.54. Is that why you took the day off?
I took the day off trying to get the courage up. I couldn't pull.
Euro dollar 122.18. Home Depot breaking out a little bit now, Lisa, up by about 1.9% in early trading.
Yeah, I think that Tom was at Home Depot yesterday trying to get materials to build Vet Bill a new home. We know that he's really handy in that area, and we expect pictures, Tom. Meanwhile, what I'm looking for today, 8:30 a.m., we've got U.S. April housing starts and building permits. We're expecting an ongoing increase in building permits as builders try to meet the incredible demand. We see this certainly in prices. We see this in a lack of inventory, slowing sales. This will just be another snapshot of that dynamic. 9 a.m., this to me is the event of the day. Treasury Secretary Janet Yellen will be speaking at a Chamber of Commerce event. Expect her to talk about how businesses need to accept higher taxes. She's going to try to sell that to them. She also may talk about inflation. Yes, she wants to steer away from trying to interfere with the Fed policy. However, the concept of transitory is not settling well with a lot of people. There was a May fund manager survey out of Bank of America this morning showing the highest level ever of investors surveyed saying they expect higher than average inflation ahead in the months to come. And then at 11 a.m., the Dallas Fed's Robert Kaplan will be speaking at the Atlanta Fed's conference on financial markets. I know that's confusing and a mouthful. Robert Kaplan, very interesting because he is the lone hawk on the Federal Reserve, John. He has come out yesterday and said that he still supports a rate hike as soon as 2022, very much going against the other Fed members.
The heritage of the hawks over at the Dallas Fed, Tom. Although I have to say a hawk these days is very different to a hawk back in the days of Mr.
That's
Fisher.
the key point. That's a key point, and I think that Dr. Kaplan would agree with you. Do I look tanned and rested? I mean, on radio,
yeah,
John,
you look
it's like
fantastic.
I'm working it.
You look great.
Yeah, I'm trying to
do you
keep
need my
up
validation?
It's like a Capri.
I don't think you do.
I had the Italian lotion that you had in Capri.
Oh,
That's what did it.
Some oil.
Yeah,
How did that
some
work
oil.
out?
Yeah, this is good.
Lisa, you mentioned that fund manager survey. I'll get this serious quickly. Expectations for a strong economy come in. For higher profits, they come in. Expectations for margins, 26%, down from 46%. That's a real turn that's starting to develop.
Yeah. Well, and frankly, it's because you're seeing these higher prices for input prices. I mean, yesterday, if you look at the New York Empire Manufacturing Survey, it showed a record high for prices paid for the actual materials that some of these factories are purchasing. This does bleed into the bottom line, John, and I think that that's what you're seeing reflected.
Let's bring in Andrew Hollenhorst, shall we? City Chief, U.S. economist. Andrew, your words. We continue to see the Fed's publicly expressed confidence in the absence of persistent inflationary pressure as raising risk of a hawkish pivot late this year or in 2022. What does a hawkish pivot look like these days, Andrew?
Well, it certainly looks different than it has historically because we're coming from a scenario of a very dovish Fed, and I think that's part of what's going on with currencies, which Tom was mentioning. So we have a Fed that doesn't want to talk about tapering, that certainly doesn't want to talk about the first rate hike. Meanwhile, we have inflationary pressures which are building. There's certainly months that you can run here with this kind of dovish rhetoric. I think that story isn't over yet, but eventually it will be over. We have a labor market that looks tighter than maybe we thought it was. We have inflationary pressures that are picking up faster than maybe we thought they were. So I think it's coming, maybe not until the end of this year, maybe not until next year, but I think at some point we will be talking about less accommodation.
Yeah, but Andrew, the heart of the matter is, and I think this is an impossible guesstimate or forecast by anyone. We're trying to figure out when the boom ends, when we normalize. How have you tweaked that along the x-axis over the last couple of weeks at Citigroup?
Yeah, so the question is, what does normal look like in a post-pandemic economy that's reopening rapidly? So this quarter, we think we'll have somewhere around 10% growth. Even with that retail sales figure, even with that jobs figure, we think we're still on track for something like that. But we will be slowing from here. And I think that's a big question for markets is, how do markets deal with a pace of growth that was so abnormally strong and is now slowing to something that looks more historically normal?
Is this time different, Andrew? I mean, we've gotten accustomed to inflation remaining below some of the more ambitious expectations of the Fed, and people are increasingly saying this time is different for a variety of reasons. Is it?
I think it's very different. I think it's especially very different for Fed policy. If you think about where we've been over the last several years, over the last over decade period, it was really a scenario where output was running below capacity, where you had no issues really about the potential to overheat the economy. Now we're in a scenario where at least temporarily we are running at a level of demand that is outstripping the productive capacity of the U.S. economy. You're seeing that in labor markets. You're seeing that in product markets. There is an open question about how long that continues for, but I think it's a more difficult scenario for the Fed because you actually have inflationary pressure. Meanwhile, you have an economy that's kind of just getting back to levels of activity that prevailed pre-pandemic.
Andrew, isn't that what we need to get people to invest in the productive capacity of the economy? We need demand to rip for once.
Yeah, and I think that's the bet that the Fed is making here, that they can stay dovish now, that demand can stay strong, that yes, you'll have some temporary inflationary pressure, and you'll come out on the other side of that and you'll have a normalized economy and you'll have inflation that comes back down again. Now, the issue that you might have is, do those inflationary expectations start to get embedded in the economy? Do they start to get embedded in the public mind? And that's what we're seeing in some of the survey data. If you look at the University of Michigan expectations, 5 to 10 year expectations, up to 3.1%, that's not a concerning number in and of itself, but the fact that we're moving quickly, the fact that we're getting to higher numbers than we've seen at least in recent years, I think that's something that's going to get the Fed's attention.
Andrew, we've got a DXY under 90. It's a big deal. What does a weak dollar mean for the United States export dynamic?
So, of course, a weak dollar is always going to be helpful for the export market. It makes it easier for foreign countries to buy U.S. exports. Really what the story has been for the U.S., though, has been the strength of imported goods. And maybe that's the more interesting story in the context of a weaker dollar, relatively higher import price, and a U.S. economy that's relying to some extent on those imported goods right now. So when we're thinking about inflation and kind of pulling on the productive capacity of the U.S., it's really the U.S. pulling on the productive capacity of the world right now and really kind of straining some of those global supply chains.
Andrew, we've got to leave it there. Andrew Hollenhorst, City Chief, US economist. Touching on Europe and the ECB and the euro just a little bit earlier this morning. Euro dollar with a 122 handle. June 10th is your next meeting for the ECB. And every day that passes, Tom, every week that passes, looking at this price action in FX and both the bond market as well, I think that meeting gets more interesting.
Well, it gets more interesting, but also it's the linearity of it. I'm bringing up the log chart here right now. What the log does, folks, is it gives you the slope in a percentage change. And I'm sorry, John, it's a nice move from a 117 up to 122. Why does that stop here? Why don't we go to 123 and on our way up to that June
124
meeting?
And 125.
Yeah, it's a linear
Lisa,
function.
You'd have to believe at some point the governing council, a member of the executive board, somebody comes out and says, we don't like this.
Yeah, although at this point you have to also wonder against which cross, right? And China is sort of the more important cross to some people based on the trade currents with Europe than even perhaps the dollar, at least on the margins. My question is, at what point do rising yields become a financial stability concern that lead to a negative cycle, and how
She's
much?
Back. Love this. Tom, she was so bullish yesterday. Tom, she had a week off, and Lisa was so bullish and so optimistic. Carry on. Sorry for cutting you off.
No,
Carry
it's
on,
fine.
please.
It's absolutely been devastated. I'm actually back to my gloomy self. But there is this question of the financial stability aspects. I mean, how quickly can yields rise relative to some of the inflationary readings that we're getting now without threatening financial stability? And this is going to be an ongoing concern for central banks around the world.
Lisa, are you thinking more from the credit side or from the periphery, the sovereign side in Europe? Which side?
In Europe, I think that it's more from the sovereign side, more from the Italian government bond yields, because that's where you're seeing the real increase. And you were talking about this yesterday.
John, I miss this so much.
I can keep going, though. The credit's a very big concern, too. I can just keep going.
Just going to encourage you for the next
radio,
couple of
can we
hours.
just bring up a chestnut of a banner? Come on, let's go. For radio, we got to bring this up.
Uh-oh.
It is the pendulum of gloom.
There it is. It's back.
Oh, we're back in town.
The band is back together. 7 a.m. Eastern Time. Andrew Sheets will be joining us from Morgan Stanley. Looking forward to that this morning. Good morning. Euro dollar with a 122 handle. S&P 500 futures bouncing back just a little bit, up a third of 1%. 41.71. Call it 41.72 on the S&P. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The Biden administration has now shifted its approach to the violence in Gaza. President Biden told Prime Minister Benjamin Netanyahu he'd support a ceasefire between Israel and Hamas. For days, the president had publicly called for calm, but not for an end to the conflict. Since last week, Hamas militants have fired more than 3,100 rockets into Israel, while Israel has pummeled Gaza with air raids and artillery. Republican senators plan today to deliver their counteroffer to President Biden's infrastructure plan. The president has called for spending a little more than $2.2 trillion. Senator Lindsey Graham says the GOP proposal could be as high as $900 billion. Republicans are opposed to using tax hikes to pay for that spending. And it would be Amazon's biggest push into entertainment so far. Reportedly, the world's largest online retailer is in talks to buy the famed MGM studio, the fabled company behind the James Bond series. According to Variety, Amazon could pay about $9 billion. MGM would help bolster Amazon's Prime streaming service. And in the UK, more than 2,300 people have been infected with a highly transmissible India variant of the coronavirus. The government said early evidence suggests the vaccines still work against the strain. Meanwhile, an England-wide ban on households mixing indoors was relaxed Monday. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Israel has the right to defend itself. There is no equivalence between a terrorist group indiscriminately firing rockets at civilians and a country defending its people from those attacks. So we call on Hamas and other groups in Gaza to end the rocket attacks immediately. I've also said that I believe Israel, as a democracy, has an extra burden to do everything possible to avoid civilian casualties, even as it defends itself and its people.
Secretary Blinken there on the foreign policy issue of the moment. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's your price action in the equity market. On the S&P, we advanced 13. On the S&P at 41.71, we are up higher by 1/3%. In the bond market, yields unchanged at 164.37. Euro dollar gets your attention with a 122 handle. Dollar index breaking 90 to the downside. An 89 handle on DXY. Heavily weighted, of course, to the single currency. In the commodity market, 66.77, up 0.75%. Commodities doing nicely, with the backdrop being a weaker dollar morning. If you switch up the board, Home Depot had a good pandemic. How many companies can you say that about? 327.78 in the pre-market, up another 2.5%. Call it 2.43% to be precise. Home Depot coming out, Tom, with first quarter comp sales of plus 31%. The estimate 20. A nice upside surprise.
I mean, those are nice numbers there, but I think it's the headlines beneath the surface there of a per square foot kind of ratios that they do every time that really show the strength there. It's really endured here through the pandemic. We'll have much more on retail today. Right now, Martin Schenker joins us, Bloomberg editor at large, and a good view of the Washington landscape as well. Marty, I look at what's going on with Israel and Gaza, and it's 25 miles of the length of Gaza. There's different parts of Gaza, but the answer is Israel's got targets they've got to mop up.
Yeah, and what they're particularly focused on is the tunnel network in Gaza. That is what Hamas uses to launch its missiles into Israel. And they're by no means are they finished, it looks like to me, even though the White House is calling for a ceasefire.
Well, the convenient thing here, given the domestic politics in Israel, the domestic politics here, for that matter, the domestic politics in a broader Arab League, the idea here is to let the clock tick, let them mop up the tunnel, et cetera, even with a horrific carnage, and then negotiate, and then calm down. What is that going to look like?
It's going to look like Israel is going to come out of this again with a Gaza Strip that is, decimated economically, politically, but it's still going to be there as a source of friction for Israel and the region. So I don't think a lot is going to change except the carnage.
Yeah.
Well, Marty, there might be something, though, that changes in the United States, in particular within the Democratic Party. I mean, Biden's facing a lot of opposition from his own party. What does that look like right now?
Well, a lot of the progressives and even the moderates in the Democratic Party are behind the scenes urging Joe Biden to be more forceful in condemning these Israel's response. He's not going there yet. Whether he does is kind of going to be played out on the field of battle, really, depending on how long Israel decides to keep this going.
Although there's a question of how much this jeopardizes President Biden's agenda, the idea that he has to wrangle Democrats with pretty dispersed views here to get something passed with respect to infrastructure, with respect to some of his social programs that he's proposed. How much does this throw a kink into this, or is this completely unrelated?
I think it's completely unrelated. Okay. I don't think the Democrats are going to hold the infrastructure plans hostage to foreign policy issues at all.
Marty, I look at it, to get back to Israel and Gaza as well, we have to be getting briefed by the Israeli military as well. What is our stance with Palestine? Who are we speaking to? Our childhood, our youth was Mr. Arafat. Who's the Arafat we're speaking to
Well,
now?
this is the real difficulty in working your way diplomatically through the region. There really isn't a personification of the Hamas political and Palestinian establishment of any significance. So it really is difficult to find the right person to talk to get some sort of a ceasefire done.
And we are all watching the situation in the Middle East closely. Before we let you go, Marty, I do want to get a sense of where we are on infrastructure spending, given the fact that Republicans seem to be coalescing around something that could be a bipartisan bill. We've talked about $800 billion, although certain Republicans have said it's likely to come in a lot lower than that. What's the likelihood of a bipartisan deal getting done, and what does it look like?
Well, as I've said here for a couple of weeks, I think it's quite possible. And even Mitch McConnell has thrown out a number as high as a trillion. So I think they will coalesce around some agreement, probably less than $1 trillion, and we'll probably see it before July 4th.
Marty, always great to hear from you. Marty Schenker there, Bloomberg editor-at-large. Keep going back to this theme, don't we? How we've redefined what a hawk is over at the Federal Reserve. We've redefined what fiscal discipline is down in Washington, D.C., something just south of $1 trillion, Tom, and it just feels like, good effort.
Well, the define will be on the yield. I mean, John, in my sabbatical that I took, foreign exchange has clearly moved. You got Brent crude with a true $70 print, the equity market, a life of their own. What's important here, John, is what hasn't moved. And what hasn't moved is a 10-year yield. Until the yield moves, they're going to still rationalize this level of inflation that we have.
We started the week discussing that when we closed out the month of March at about 174. That was your closing high. Since then, we've had a closing low of about 154 and an average of about 162. And that's basically where we are at the moment. So what's the takeaway from the price action, Tom? What does it tell you?
It just tells me that the sweat's not there yet. I mean, there's a lot of worry and there's angst, and we hear that from our guests as well. But the believers in the market are like, well, that's okay. The yield is where it is. My question, John, is where's my entry point on BitDog? I mean,
BitDog?
I took it off, as an emergency day off yesterday to calculate that. I couldn't pull the trigger at 45,000.
Elon Musk whipsaw in the asset class, and in many ways too. Do you think he's undermining it as well?
Yeah, I talked to Elon yesterday, and I just said,
spoke to Elon.
Where do I go in? Where do I,
You know this is a news network, Tom. You can't just make stuff up.
Oh, really?
It's in shock.
I just want to build my position in BitDog.
Some people might believe you, Tom, that you had a conversation with Elon yesterday.
No, they wouldn't.
They might do. As you're walking through Central Park with the dog, talking to Elon. 41.69 on the S&P 500. We advanced 12. We're up about 1/3% this morning. A lot of discussion about euro dollar at 122.
Getting it done.
Dollar index south of 90 rather at 89. And Home Depot does get it done, Tom. Sales just delivering a nice tidy upside surprise, and we'll hear from Walmart and Macy's a little bit later this morning.
They're only up 27% per year for the last 10 years. That's a lot for, a 2x4.
Macy's is that classic story of survival, isn't it? Up 70% year to date so far. And Lisa, surviving, not thriving. Can they thrive in a post-pandemic world?
It really depends on their online strategy, right? And that's something that people are going to be looking at, and how much they can compete in an era where brick and mortar is more and more obsolete. I want to make one observation going back to the bond yields, because you were saying it's boring, it's stable, blah, blah. Real yields. Tom, I'm shocked you didn't mention them. Real yields heading back even more negative.
They're grim, 5-year.
Yeah, I find that fascinating.
I think John will have to have an extended show on
Tom
Friday.
Keene,
on negative yields.
Lisa Abramowicz, Jonathan Ferro, herding cats coming up. Steve Orth, Federated Hermes Chief Investment Officer for Equities.
Show, John, on Friday,
from New York City. That should be a promo.
John,
that's the show.
Herding cats.
This is Bloomberg. $6:30 Eastern. Here's the price action in New York this morning. Good morning. Equity futures advanced about 12 points on the S&P, up 1/3%, doing nicely on the Nasdaq. We bounced back up 0.7%. The Russell up by about 1/3. I'll keep this brief. Switch up the board into the bond market. 2s, 10s, 30s. Snapshot of the Treasury market for you. 2s unchanged at 15. Your 10-year at 164.54. Talked about the average, the range. Lisa talking about the negative real yields at about -92, -93 basis points at the moment. Remember, start of January, I think January 4th. We were looking at -1.1. Just get your head around that. We've been much more negative than this before. Can we go there again? Finish on this. Switch up the board. You hear a lot of people in the bond market talking about things like the bear steepener. So let's think about what that is. Compare 2s to 10s, a 2-year maturity, the yield on that, to a yield on a 10-year maturity. When people talk about a steepening curve, it's the difference between the two getting wider. When they talk about a bear steepener, it's driven by the long end selling off and yields climbing on, say, a 30-year, a 10-year. Here's 2s, 10s right now, pretty stable over the last month or so at 149 basis points. And Goldman's saying, take profits on this as we move towards peak growth and move past it. That's their call over the last week. And Tom, we've had a big move on 2s versus 10s, and we're just starting to level out over the last month or so.
One of the first charts I looked at this morning, John. I do agree with you. The dynamics in the bond market extraordinary. As Lisa mentioned, the real yield telling a real story. But the classic spread now, it's really range bound, isn't it?
Very much so. On 10s, you want the range, Tom? Just briefly?
Yeah,
174,
please.
you're closing high. End of March, 154, you're closing low. Just a couple of weeks ago.
I've been looking at a lot of the ranges out there right now, and one of the ranges is the equity market. We lose perspective. That's all there is to it. If you look back 12 months, it's real simple. You're looking at 40% returns. The Dow, Standard & Poor's 500, the NASDAQ 100 does fractionally better. There's the back and the forth and our guests and all that. And then there's those that say you have to participate. Stephen Auth, with decades of experience with Federated Hermes, their chief investment officer of equity. Steve, one, congratulations for having the courage to stay in this market. But what is the now what? With your optimism, you're in the market, but how do you continue to participate after a 40% pass, 12 months trailing?
Well, you probably read some of our tone in our pieces, Tom. We're getting a little bit more cautious here. I mean, we've had this longstanding 4,500 target for the end of this year. We're only 7-8% away right now. So we think it's less about the market here than more about the stocks. We are worried about the inflation risk. We are not yet prepared to call this a policy error, but I think the risk of policy error is rising quite high. And, I do think I disagree with you both on this range bound thing on the 10-year. I don't see that at all on my charts.
Steve, you can't disagree with the range. It's just basic maths. It's where it closed and where it finished the day. What do you disagree with?
Well, I tend to run longer term charts than you, Tom.
Well, that's fair enough,
John. And so I remember having a discussion when we were ranged between 65 and 95. And we've moved 100 basis points. I think the 2 to 10s is going to 250. And I think that's about where the 10-year is heading. So, if we're wrong about the inflation forecast, that won't happen. But we really disagree with the Fed on what they're doing right now. And I think there's just a wall of money coming out of this economy.
Well, we usually don't do this with you, Steve, but I'm going to do it right now. Mr. Kaplan of Dallas is in the Auth camp as well. Are you suggesting that Mr. Kaplan won't be so lonely in the coming weeks?
I hope so. We're hoping we get a little bit of change of tone out of the Fed. I'm not so sure, though, Tom, but that's what we're watching for here. And I think if they do, they can let the air out of this a little more gradually. But if they don't, I think, the 2 to 10s will make a new high. We'll go from the 175 high. I think maybe 2 will be the next. We're making higher highs and higher lows here on that spread. And so on the stock picking side, to answer your original question, we're just focusing entirely on companies with pricing power, and that's often our focus anyway. But now it's all the game because inflation and high nominal GDP growth can be good for some stocks. I mean, they produce high nominal earnings. So you just got to be in the companies that can deliver that to the bottom line and not be squeezed by margins. We think that's mostly, frankly, in the cyclical value type stocks, not entirely. But you combine that with the year-over-year compares on tech, which are now going to start getting tough. We're still on this value trade that we've been on since last September. And particularly within that now, we think it's really becoming a stock picker's game here. You just can't buy across the board, almost industry by industry. There's companies that seem to be demonstrating some pricing power and others that don't.
And Steve, just to be clear here, so we characterize both positions fairly. Tom and I talking about the range we've been in since the end of March, which just by definition has been from 174 down to 154. You're talking about breaking out of that range through the future, and not for me to advocate for a call through the next several months or into the new year. That's your call. So, Steve, you're looking for something north of 2. When you're talking about how to position in the equity market, does that just scream banks?
Banks are one of the big things we're in. I still like JP Morgan here. I've liked it all the way up from 90, but we still like it here, Jonathan. I mean, if you look at the analyst forecast on JP Morgan, $12 out a year or two, basically they got a flat earnings call here. That's just not going to happen in the environment we're thinking about. So That's a stock that's trading under 12 times earnings against the market trading almost double that. It's a good example of the kind of stock that benefits very much from this environment that I think we're heading into.
Steve, what do you say back to the happy talk about investing in the European names, the European lenders, and maybe not the big banks on Wall Street?
We are increasing our allocations to Europe because if the bond market vigilantes don't do it, Jonathan, I think you and Tom and Lisa have been on to this, the currency market vigilantes are going to do it. And to a certain extent, that's what we're seeing now with the dollar continuing to weaken. We think that's likely. In fact, maybe that becomes the disciplinarian here on the Fed, who to a certain extent can control the treasury market. So, I think, you always want to have some international stocks in your portfolio. We've been increasing that allocation. We were underweight for several years. We're kind of neutral to overweight now and still adding there. Now, when you go to Europe, you got to be looking at the banks, kind of closing your nose, though. I mean, they don't have the same environment we have here. So we're looking at other things with pricing power that can benefit from this lift than the banks. But we are looking at some of these banks. In fact, we own a couple already. So, but they wouldn't be on the top of my list, frankly, for European stocks right now.
Stephen, we've heard a lot about mergers and acquisitions recently, including the talk of Amazon.com possibly purchasing MGM, the latest in the streaming acquisitions. I'm wondering, from an investor's standpoint, do you like the M&A activity that you're seeing, or does it concern you?
Lisa, to be honest, I don't completely like it. I mean, I see the dynamics of why you'd want to get bigger in this space. We've come through a period where media assets have done extraordinarily well relative to trend because of all the COVID lockdowns. We're exiting that period now. These folks toss around there may be the new energy companies, pouring billions of dollars into the ground. They're talking about 20 billion of investment over there at AT&T Time Warner. That's a lot of money going into content, and there's an awful lot of content out there. It's no longer, as we all know, it's no longer 3 or 4 network televisions, right? So I can't say this is our favorite space right now.
But Steve, this is a really interesting call, saying that some of these streaming companies may be the new energy companies. Some of these investments may end up being wasted money or good money thrown after bad. To what degree are you rearranging assets, selling assets around this, trying to fade not only the Netflixes and Disney Pluses, but others that may be in a similar boat?
Absolutely. We're as you know, as I've spoken about before, but we're long the energy companies and adding. I've got an oil price target of $90 this year, potentially higher. And I think more importantly, likely to stay there for a while. They've been hated for so long. No one has been drilling. I mean, unlike the media companies that are loved, they can say they're going to spend $20 billion on content and nobody blinks. The energy companies basically aren't allowed to drill holes in the ground anymore between their investor base and the government and everybody else. So you've got a stock of assets in the ground, no new assets coming, undersupply of capacity all over the world, and a booming global economy post-COVID. I don't see where this oil price inflation stops, honestly. And I think it's probably, our view is it's longer lasting than most of the street thinks. I mean, there's been others out there with this $90 idea. We've been there for quite some time, but I think the real call is how does it last into 2022? And we see no end in sight on that.
Wow, Steve, 90 on WTI this year, and you see it persisting through next year.
Yeah, I think 90 this year and potentially higher, Jonathan, but not a lot lower next year.
Steve, that's a massive call. We've got to pick up there next time. Steve Orth, Federated Hermes Chief Investment Officer for Equity. Steve, always great to catch up with you, buddy. Good to hear from you. Let's talk soon. Tom Keene, $90 on crude this year. Right now, 67. Brent had a look at 70 this morning. It's staying there.
To help our audience on this and how we massage that, it's just one call. But the tendency, John, is to frame from 70 up to 90. I haven't heard $100 yet. And there's a dispersion of calls there. And the answer is higher. Is that set of calls.
Yeah, that was about as close as someone has come to saying 100 next year, Lisa.
Well, This comes on the heels of an International Energy Agency report that came out this morning, and the Financial Times was reporting on this, where they recommended that energy groups must stop all new oil and gas exploration projects in order to meet some of the global warming targets. This is massive call from a fossil fuel friendly organization that has been pro-oil. The idea that even a pro-fossil fuels agency is saying stop drilling, stop making those holes is a big deal, and it does limit the potential for production if people follow through. So just to give you a sense of what could be underpinning Steve Auth's call here.
Crude pushing higher, Brent with a 70 handle. A big discussion this morning, up 0.8%. Your dollar weaker, supporting the move in commodities. Euro dollar with a 122 handle. And equity futures up nicely, up 1/3% on the S&P. We advance around about 12 points. You had it there, TK.
I had it.
It was just the opening was there for you, mate.
It was.
Why don't you take
there
it?
like at 8
Why don't you take it?
It walked away with Elon.
I had to walk that bill.
Did Elon talk you out of it? I'm sorry. With Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. For our audience worldwide, this is Bloomberg.
That bill almost bit Elon.
With the First Word News, I'm Ritika Gupta. The U.S. is now adding pressure to both sides to end the conflict in Gaza. President Biden has shifted his approach. He told Prime Minister Benjamin Netanyahu he'd support a ceasefire between Israel and Hamas. For days, the president had not publicly backed an end to the fighting. So far, at least 222 people have been killed, most of them in Gaza. Hamas militants have fired more than 3,100 rockets at Israel. Israel has responded with air raids and artillery. The U.S. Senate has voted to move ahead with a bill aimed at countering China's rise in technology. The legislation is backed by both Democrats and Republicans. It would jumpstart research and development with a cash infusion of more than $100 billion. The bill could be passed by the end of the month. Argentina is trying an unorthodox move to try to contain inflation that's approaching 50% annually. Beef producers have been told they won't be allowed to sell their product abroad for 30 days. It's a sign the government is willing to sacrifice much-needed dollars from exports to appease local consumers before a midterm election. And Harvard has urged the U.S. Supreme Court to reject an effort to bar colleges from using race as a factor in admissions. The university says that would append 4 decades of legal precedent. A group called Students for Fair Admissions is asking justices to review a case against Harvard that it lost. The court's new conservative majority may be more skeptical of race-conscious admissions. And one of the best-known meme stocks is headed for an 8th straight gain. AMC Entertainment rose in pre-market trading amid renewed interest from day traders. The stock has soared 55% over the past 7 sessions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
By the end of June, when we will have taken delivery of enough of such vaccines to protect everyone in the United States will share at least 20 million of those doses, that extra supply, with other countries.
America stepping up. The President of the United States there, Joe Biden. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's your price action this Tuesday morning. Equities advancing on the S&P 500, up 12. We're up about 1/3%, just a little bit firmer here. Risk appetite improving, dollar weaker across the board in G10, EM, the European proxies outperforming in emerging markets, with the euro firmer by about 0.5%. Stronger euro dollar 122.15. A dollar index heavily weighted towards the euro. The single currency, 89 handle this morning. The 10-year, 164.71, yields totally unchanged, and crude 66.67, up 0.6% today. Brent at 70. But take a look at WTI, because Steve Auth, the Federated, came on about 10 minutes ago, Tom, and he's looking for a 90 handle on WTI this year.
Well, the importance is a 70 handle on Brent crude right now. That's a lift up here. It's been gradual, but nevertheless, finally, a 70 print, and everyone, including equity managers like Mr. Auth, recalibrate as well. Right now, well, it is an essay that gets your attention. Let's get right to it. He has been our most direct and assertive guest here on the pandemic. Amesh Adalja, writing in The Hill, and I'll tell you, folks, it's real straightforward, and it gives pause as well. Let me bring that up right now. I have characterized testing as the original sin of COVID pandemic. There are very few reasons to test asymptomatic individuals beyond facilitating the COVID-exposed, unvaccinated, ending quarantine early, or the unvaccinated international travel. Fully vaccinated persons, as the CDC guidance states, should not be tested unless symptomatic. Dr. Adalja joins us right now. What's the next step, Dr. Adalja? That's quite a statement here. So then what is the best policy for America?
The best policy is to really focus on testing symptomatic individuals and people who are exposed and unvaccinated who need to end quarantine early, because right now we're in a position where we are getting false positives because the prevalence of infection is falling, and we're in a place in this pandemic that we haven't been. Over 70% of people above the age of 65 have been fully vaccinated. Those were the people that gave us this public health emergency. Those are the ones that were getting hospitalized. We've increasingly removed the ability of this virus to threaten our hospitals. So now we've kind of gotten to a point where this is like other respiratory viruses, and we have to start thinking about it like other respiratory viruses. We don't test people asymptomatically for influenza, so I think we probably need to start ratcheting back a lot on this asymptomatic testing and focus on vaccinating people and testing people who are symptomatic, either if they're vaccinated or not vaccinated, because I think we're in a good point, in a good trajectory. And I think
Speak to schools right now. It's May. We got to get to August and ramp up to September school start. Are you saying COVID and influenza, that there's little distinction, that there's little difference?
when it comes to younger children, what we find is that COVID-19 and influenza probably are about comparable risks. They are both they both have the same burden of illness in children. Actually, arguably, you could say influenza has a higher burden in children. So what schools do for influenza, that should be what they're doing for COVID-19. And I think it's even more the case because the vaccine for COVID-19, which students 12 years and up are eligible for, is much more effective than the flu vaccine. So I think we're in an okay place when it comes to schooling. I don't think that pool testing or asymptomatic testing is something that we should do in schools because you're going to get a lot of false positives. You're going to have a lot of disruption. I think that we can continue the other mitigation measures of masks, trying to vaccinate the population, social distancing, but schools should be open now, and I don't think testing should be a barrier for opening schools.
Dr. Adalja, can you square the discrepancy between what you're saying, which is essentially we're moving into a new phase of the pandemic where it's no longer the pandemic, but it's just another illness that we need to deal with on a regular basis, whereas we have Singapore locking down after a handful of cases that have been detected in the community. What is the potential approach that you see as the correct one internationally, especially as we see the cases surge in places like India?
So I think if you've got a highly vaccinated population, you have a whole different menu of options that are there. If you're a country that's not highly vaccinated like India, then your only options are those same what we call non-pharmaceutical interventions where you have social distancing and you have advising people to stay at home. All of that is something that you don't have to do if your population is highly protected with the vaccine, especially those high-risk individuals. So I don't think what Singapore is doing is correct. I think right now the U.S. is on the right policy. For the first time probably during the pandemic, the U.S. actually has the correct policy where we've decoupled cases from severe disease hospitalizations and deaths, which is exactly what the vaccine was designed to do. So I think that that's the policy now, is to vaccinate your population as much as possible. And the only reason that you should be pushing these non-pharmaceutical interventions is if you have not vaccinated enough of your high-risk populations and you're worried about your hospitals going into crisis. We've removed that ability in the United States by vaccinating those high-risk individuals.
Dr. Adalja, we also, though, are looking at strains and other variants, and people sometimes point to that to say, look, we need to still remain vigilant and still remain cautious with respect to tracking the virus and making sure that you take social distancing precautions. And do you think that's fear-mongering? Do you think that that's sort of unnecessary given the fact that a lot of the vaccines have shown to prove effective against some of these strains?
Definitely, when you have a fully vaccinated population, a high percentage of your population fully vaccinated, those variants, even the more problematic variants like 1351 from South Africa, they are still unable to cause serious disease, hospitalization, and death. Certainly, if you're an unvaccinated person, those variants do pose a risk to you. And if you're an unvaccinated country, it can be a real problem, as we've seen in places like India. But I think that the variants are something that our vaccines are very robust against. So the solution to the variants is to get vaccinated and to vaccinate as much of your population as possible.
Dr. Adalja, Always good to hear from you, sir. As always, come back soon. Dr. Emma Shadalja there of Johns Hopkins Center for Health Security, senior scholar. Just to read out that line from his essay in The Hill again, Tom. Fully vaccinated persons, as the CDC guidance states, should not be tested unless symptomatic. Corporations, states, regions, cities, they've got to work this out in the coming weeks and months.
They're going to work it out day to day, John. I mean, this is like every other pandemic, every other bacterial or viral illness. There's a sequence here. And, every day we're doing it. Afterthought got the first shot this weekend. There were 50 people in the room of all different ages getting their first or their second shot. You know what? It's just day after day, and we'll sort it out. I agree with you, though. Right now, it is not sorted out.
You get the new guidance from the CDC, Lisa, and it just takes time. I think companies have just had to take extra time to work out what on earth they're meant to do.
There's a lot of confusion because there's a lot of disagreement within even health professionals, and we hear this on this show every day when people come on. You've got, Dr. Sharfstein coming on and saying it's really important to remain vigilant. You have Dr. Adalja saying we're moving into a new phase where we have to treat this virus like any other, like the flu. And this, to me, is part of what's stemming from the confusion. This is new. This is a big experiment. We know this. But then how do we sort of direct our lives going forward?
Go on, Tom.
Well, it's just simple. It's a pendulum of confusion.
Is that what it is now?
It's simple.
It's everything, including.
I wish it was simple. Home Depot, one of those companies, dropping the mask mandate for fully vaccinated customers, and Home Depot knocking it out of the park this morning. The numbers are decent. The stock's doing well. Coming up, Walmart and Macy's earnings.
Did you say, John, that no mask in a Home Depot?
No mask in a Home Depot.
I didn't know that.
Pendulum Home Depot.
Mask mandate.
Interesting.
Equity futures up 11 on the S&P. I'm pleased you were listening. Up a quarter of
maybe
1% on the S&P 500.
For the first time.
This is
Did you
Bloomberg.
see me in a Home Depot?
There's a lot of cash in the economy. There's a lot of cash on balance sheets, and this cash will get deployed one way or the other.
People, they don't like inflation. This is true, but they will tolerate it.
Inflation is going to be eating into the real wages of low-income households.
Transitory gives the impression of over and done very quickly. I don't think that's what we'll see.
When we get through the noise, when we get through the supply-demand imbalance, will prices stay sticky or not? The market seems to say no.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. In your equity market, we advance a third of 1% on the S&P 500, up 12 points. In your equity market, we have some earnings and raising guidance. Macy's raising guidance, Walmart. The outlook improves for these retailers in America, Tom.
John, it's a really, really important headline from Walmart. We're seeing from Home Depot, Macy's, and Walmart nominal GDP optimism. And I love how they phrase a 2-year stack. John, I predict we're going to see a lot of this. You're going to see a lot of people recalibrating back to 2019 and looking at a broad, you talk about getting over the bridge, John. They're going to get over it with a 2-year stack.
The line from Walmart, our optimism is higher than it was at the start of the year, sees continued pent-up demand throughout 2021. It's pretty constructive stuff.
On the conference calls, John, there'll be a lot of talk, as Steve Auth mentioned, of pricing power. I loved how Steve Auth said he's going for companies that display pricing power, and you wonder who those will be. It'll be a source of, it'll keep us employed at least to the end of May.
Thank you, Tom.
Yes.
Keeping us in a job at least until the end of May.
Transitory.
Which is like 2 more weeks. Lisa, Macy's, what a run that company's had, up more than 70% year to date. They raised their outlook. Walmart, struggling year to date on the stock, but looking ahead, they see a better future.
Yeah, and shares pre-market up about 1%. Just to put this into context, what's driving this is savings and disposable income. And you actually saw disposable income, personal income in March surge to a record high, about 30% above its pre-COVID level. This is according to some Cornerstone macro research, just to give you a sense of what's driving this pent-up demand. People have money to spend, and the real question for the economy is how long will it take for them to wind that down, and what will the bleed-through effects be in the broader economy, John?
Here's a headline for you, Lisa. Raising the forecast on the U.S. desire to get out and shop.
Isn't that the case, though? I mean,
very much so.
Very American, I got to say. I mean, it's true, though. This is what you hear. This is what you see when you go outside. I mean, if you look at restaurants, if you look at shops, I mean, you see it, I see it, Tom sees it, Vet Bill sees it, Elon Musk.
The dog, all of the above. It's a hat trick for America's retailers this morning. Home Depot, Macy's,
listen to you
Walmart,
with the hockey talk.
Equity futures. That's football talk, Tom. Up 12 on the S&P 500.
I didn't know that.
It is. Here's the price action. It's Tuesday.
Football.
Shaping up as follows. We advance to the equity market. In the bond market, yields 164.37. Unchanged on the day. Tom came into the studio this morning and screamed. The FX market, John, euro dollar 122.11. We advance a half of 1%. Tom, it's a stronger euro. It's a weaker dollar. A dollar index with an 89 handle this morning.
And what's important about this, everybody's talking weak dollar. We've got a guest coming up where his shop is like, maybe not.
We'll get to Morgan Stanley on the maybe not in just a moment. 66.56 on WTI. Lisa, Steve Forth, 90 this year on WTI.
And this has been really quite a story, this question of production versus demand. We see demand increasing. We saw, of course, the shortage stemming from the disruption last week. Meanwhile, you have this idea of a potential withdrawal from drilling due to concerns about global warming. We will dig into all of that. What I'm looking for today, just to go, run you through the events I'm watching, 8:30 a.m., a slew of housing data. We've got, of course, April housing starts and building permits. I'm looking at the building permits. How much are some of these builders looking to meet the incredible demand because Americans just want to go out there and shop, as Walmart seemed to put it. 9 a.m., this to me, again, is the event of the day that I'm going to be watching. Treasury Secretary Janet Yellen is speaking at a Chamber of Commerce event. Expect her to talk about tax rate hikes for corporations. She wants companies to be on board. Good luck with that. Also, she's going to be talking about inflation, transitory. At what point do we care? And this is something that I think is very important. We were talking last hour about that University of Michigan survey showing expectations for 5 to 10-year inflation among consumers rising to the highest level since 2011, rising the most since 2009. That is significant. That gets the Fed's attention. 11 a.m., the Fed's Robert Kaplan is going to be speaking at an Atlanta Fed conference. Very interesting to hear what he says about being the lone hawk on the Federal Reserve, wanting to raise rates in 2022. He is a non-voting member, but still interesting to hear the dissent among an otherwise very dovish Fed.
Is Lisa counter-programming this morning, Tom?
She is.
Watching Secretary Yellen. At 9 o'clock, there's also a radio show taking place on Bloomberg Radio. There'll be a TV show.
To be talking about
seriously,
it.
John, I'm really looking forward to talking to Paul Sweeney about what we've seen in media the last couple of days.
It's not throwing shade.
I'm
allowed to be excited.
I agree with that. You're going to be Secretary Yellen free at the top of the 9, Tom.
I have no idea.
You're talking
my people
about
handle
soccer.
that. I have no, John, I have no idea. I'm just, I'm looking for an answer.
You'll do what you're told, I'm sure. Lisa, thank you. I'm looking forward to 9 o'clock
John.
Eastern too. I hope they just play that, and then I just won't do my show. This from Walmart, the team breaking down the numbers on the live blog on the Bloomberg terminal. The headline that's really grabbing me here is the 37% surge in Walmart's e-commerce business. That from our reporter here at Bloomberg, Thomas Buckley. The e-commerce side of the business, Tom, even with reopening, continuing to do well.
Well, yeah, they're buttressed up against Amazon, and really it's the two of them. And, again, John, this is a lot like the streaming thing, and this is something Andrew can talk about. This is we're compressing all these industries into a scale-driven few, and that's what you're seeing in retail online as well.
Let's bring in Andrew Sheets and Morgan Stanley, the chief cross-asset strategist. Andrew, let's start with your quote, sir. Quote, investors face early cycle timing, increasingly mid-cycle conditions and late-cycle valuations. Andrew, what does that mean?
Yeah, thanks. Good morning. It's nice to be here. So, if you think about where we are, just a little over a year from the lows of activity, the lows of markets, usually that would be a pretty safely early cycle position. If we think about the last 3 or 4 cycles, they've been, 7, 8, 9 year events. And so being 1 year out is still safely early in that process. But if you think about the conditions that we have, that very strong recovery in consumer spending, rising inflation, our economists think you'll see a lot more CapEx spending start to come through the system. Those are much more mid-cycle dynamics. You could throw in a peak in PMIs to that as well. And then valuations on many asset classes look more late cycle. They're relatively expensive. That obviously varies. So this is a pretty complex picture for investors and kind of deviates from maybe a year ago or 6 months ago when those early cycle signals were much more consistent.
I got to congratulate Andrew on having a mid-year review published on May 16th. I just think that's the way they do it at Morgan Stanley. Andrew, you've got a grid showing a real bias to international, a bias to European equities as well. Is pricing power an international concept, or is that really a concept for the American market?
Well, I think it matters. I think it matters everywhere. I think it will matter more in the U.S. I think it's that quality theme is a more important theme for Mike Wilson in our U.S. equity call. I think where Europe and some of the international developed markets have an advantage is, I think we know that the next 6 to 12 months are going to be a real debate between good data, but this question of, is that good data too good? Is it going to lead to higher inflation? Is it going to lead to a central bank policy response? I think that is going to drive a lot of the market debate over the next 6 months. And in Europe and to a lesser extent Japan are just in a very different part of that debate. They are not as expensive. Their inflationary pressures are not as significant. I think their central banks will be much slower to respond to any rise in inflationary data. So I think that gives them a big advantage. And you just mentioned on your program, Secretary Yellen will be talking about tax increases. Again, that's a story that might impact the U.S. market, but isn't currently on the table in Europe or Japan.
And one thing that you're talking about is higher inflation and why that leads to your call to downgrade credit to neutral from overweight. And I'm trying to understand what the bigger risk is to markets based on valuations currently. Higher than expected inflation or lower than expected growth, right? I mean, these are two concerns, and this basically is what people are pitting themselves against when they talk about the Fed and being perhaps counter to their view. Where do you stand on that?
Well, I think for markets broadly, I think weaker growth would be the bigger risk. I think we saw that, throughout the last, and I think that was a defining feature of the last cycle, the post-GFC period. It was all about risk to the downside. Now, as much as we're all talking about inflation, I think we all need to acknowledge that, growth improving, inflation picking up, and central banks eventually raising rates is a incredibly normal pattern of behavior. That's happened time and time again. So that's a very normal thing to happen as things improve. And it doesn't, I think, preempt the idea that we're still in a bull market, things will still be better. Where I think credit starts to get into a challenge, though, is that if we're talking about a hotter cycle, if we're talking about central banks having greater willingness to run a higher pressure economy, as our economists say, then that's an environment where credit investors, they don't benefit if growth is better, but they are still exposed if that kind of hotter growth means that the next downturn is closer than it would otherwise be.
Andrew Sheets, got to leave it there. On that important note in the credit market, Morgan Stanley chief cross-asset strategist. Got some earnings to pour over this morning. We've had them from Walmart, Home Depot, Macy's. Macy's in the pre-market up more than 5%. They lift their outlook. Walmart in the pre-market up by 2.25%. They raised their outlook. We've seen the same again and again and again this morning, Tom.
Yeah, we did. Steve Sadov, of course, the inventor of Exclusive at Saks, working as chairman of MasterCard as well, really mentioned that the department stores are really doing well for the first time in ages, coming off the bottom of the pandemic. I don't know how sustained Macy's is in their excellence, but look at John Walmart, and particularly look at Home Depot. It's just quarter after quarter after quarter of execution.
The S word is the right word, sustained. Will it be sustained?
Yeah.
And is this just a reopening trade? Macy's this year, Lisa, up more than 70%. Is that the trade? Is it done? Reopening. What about the sustained path forward?
And this has to do with how long it takes for the cash infusions that people have in their savings accounts to bleed through the economy. How long does it take for them to spend it all? And who has this money? Is it the people who have the most inclination to spend, the lower income families? I just want to give you this statistic. Walmart reported that its U.S. e-commerce sales rose 37% in the quarter. That is compared with the average analyst estimate of 24%. I mean, the shift to online commerce has just been astronomical.
I said that 5 minutes ago.
I know. I just can't get over that.
Thomas Buckley of Bloomberg News.
I love when I go to Macy's.
You guys just don't listen to me, do you?
I listen to you all the time. I wanted to emphasize this.
You guys just don't listen to me.
John,
I'm done. I'm going to walk.
John.
Coming up, a good friend of mine, Chris Harvey of Wells Fargo. Looking forward to catching up with Chris, the head of equity strategy. We usually talk on The Open on Bloomberg TV. We do that together.
What time is that?
That's at 9 Eastern.
Oh.
Really?
So maybe Chris can hold over and catch up with me and Mike Wilson from Morgan Stanley a little bit later too.
At Macy's. I need
From
Roland's.
New York.
I love Roland's.
Did you hear about e-commerce sales, John?
With the First Word News, I'm Ritika Gupta. The Biden administration has now shifted its approach to the violence in Gaza. President Biden told Prime Minister Benjamin Netanyahu he'd support a ceasefire between Israel and Hamas. For days, the president had publicly called for calm, but not for an end to the conflict. Since last week, Hamas militants have fired more than 3,100 rockets into Israel, whilst Israel has pummeled Gaza with air raids and artillery. Republican senators plan today to deliver their counteroffer to President Biden's infrastructure plan. The president has called for spending a little more than $2.2 trillion. Senator Lindsey Graham says the GOP proposal could be as high as $900 billion. Republicans are opposed to using those tax hikes to pay for spending. And it would be Amazon's biggest push into entertainment so far. Reportedly, the world's largest online retailer is in talks to buy the famed MGM studio, the company behind the James Bond series. According to Variety, Amazon could pay about $9 billion. MGM would help bolster Amazon's Prime streaming service. And Home Depot posted stronger than expected results for the first quarter. It's a signal that the home improvement trend still has room to expand. The chain's same-store sales came in the U.S. Almost 30% in the period ending May 2nd. Home Depot did not provide any fiscal guidance. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We expect purchases to continue at the current pace until we've made substantial further progress. Through that April employment report, we have not made substantial further progress, but as the data comes in, we as a committee will have to evaluate that and ultimately make a judgment on that. We will certainly give advance warning before we anticipate scaling back the pace of those purchases.
That was Richard Clarida there, the Federal Reserve Vice Chairman, on the path forward, sticking a script from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's your equity market this Tuesday morning in America. Up on the S&P 500 by a third of 1% to 41.70. In the bond market, yields basically unchanged at 164.37. Euro dollar with a 122 handle, up a half of 1%. Dollar weaker against everything in G10. The dollar index capturing that story, breaking down to an 89 handle. If you switch up the board, retail in America looks like this morning. In the pre-market, Macy's up by 5.7%. Home Depot up by more than 2%. Walmart up by 2.7%. It's beats across the board here, Tom, raising the outlook, the guidance for the year ahead.
Yeah, John, and to the bull market here and the tone that we get from retail, the VIX at 19.37 really gets my attention. Maybe we're not out to record highs, S&P 500, Dow, whatever, but the VIX is telling us here of the tone here of finding a general bid in the market. We spoke in our last hour about Israel, of Gaza, of Palestine, and the territory there. Let us now look at this issue in Washington. Our Jack Fitzpatrick joins us, our Bloomberg government reporter. Jack, just real simply here, within the textbook, the Israel lobby, is there a generational shift in Washington?
When it comes to the Israel lobby specifically, it's a little hard to say. There is, I think if we're pointing to a generational shift in Washington, the Democratic Party may be experiencing one where it's not just members on the far left who want to push back more on Israel. It's a larger chunk of the Democratic caucus. We saw most Senate Democrats call for a ceasefire before Biden did. On the Israel lobby, the status quo is still very strong. Mainstream Democrats and Republicans want to very, very clearly stand with Israel. So if there is a generational shift there, it maybe hasn't entirely come to fruition just yet.
What do you anticipate in the coming weeks that would be different in tone from 2014, I believe it was, or going back, say, as something as large as 1967? What will be the ballet, if you will, as we get beyond the 9 days of fighting that we've seen?
Well, from the U.S.'s perspective, the news yesterday that President Biden did bring this up with Netanyahu, calling for a ceasefire, saying he wanted to see a ceasefire, was significant. But clearly, Biden is going to play this in a very sensitive way. Yesterday, Jen Psaki, the press secretary, was asked if Biden sees this as a disproportionate response by Israel. She wouldn't go that far, wouldn't use the word disproportionate. The specifics on how the U.S. follows up on this are going to be very important. Do they ask for more evidence about Hamas weapons in certain locations? But really, in a public-facing way, the U.S. is handling this very, very delicately and maybe giving a slight nudge to Israel rather than real pushback.
Jack, the fact that we're talking about this first and foremost when we talk about Washington policy highlights how international policy has really dominated the discourse around President Biden over the past few weeks. And sort of piggybacking on that has been his push to export approved vaccines to other countries. He tried to paint that yesterday as a way to develop jobs in the United States. How is it being received at home?
It's being received relatively well just because of our own vaccine numbers here. His goals appear to be probably within reach. At this point, we're at about 60% of American adults having gotten at least one dose of a vaccine. His goal was 70% by July 4th. So we're at a point where the progress that the U.S. has made on vaccinations, plus, unfortunately, the number of people in the U.S. who still are not willing to get one, means there are millions of doses that probably couldn't be used in the U.S. He hasn't really gotten a lot of pushback there. The challenge, again, for domestic policy really is how many people who are hesitant to get vaccinated would be persuaded. But the shipping out of these internationally has been fine so far.
And the challenge also for this administration is trying to push an agenda that deals with a pandemic economy, with an economy that increasingly looks post-pandemic, that looks like it's climbing out of some of the holes that it has been in. Where has Biden's policies been in the past couple of weeks in terms of making progress through Congress in order to get actually passed?
Well, one issue there is the conversation on paying for his legislative priorities is a difficult one. They do seem to be making progress on an infrastructure bill. There's going to be a meeting today with two cabinet secretaries, Buttigieg and Raimondo, with Senate Republicans. It does seem like there's some momentum on what they want to spend money on, but there is still a push from Biden in particular to not just deficit finance this. His fiscal approach going forward is more, we need the revenues to pay for whatever we want to spend. That's where it gets very difficult. So on the spending front, things seem to be going pretty well between Biden and Senate Republicans. The question, as it has been for the past few weeks, is can they agree on anything tax-related or something more creative? IRS enforcement, increasing enforcement is the latest thing they've talked about that could raise some money. But that still remains the biggest challenge in terms of the tax issues.
Jack, just quickly, can you imagine a situation where they come to an agreement on infrastructure spending with Republicans and then just deliver a separate package elsewhere that includes tax hikes?
Yes, that's the expectation. In fact, Roger Wicker, a Senate Republican, said that seems to be clearly Biden's plan, is to do something bipartisan as much as they can, and then Democrats can take a second shot at something partisan if they want.
And then you go into the midterms by saying, look, we did what we said we would do on taxes, and we managed to get a bipartisan infrastructure deal down in Washington. You can see how they're trying to build up the optics there, maybe. Jack, thank you. Jack Fitzpatrick there, Bloomberg government reporter down in D.C. Tom, you've been on top of that through the last several months, in fact, since the first week in November, the race to 22.
Well, yeah, the race of 2022, I thought it started, I think it was 2 weekends ago, John, and it'll drive forward here. It goes into the primary season. We see it with the New York mayor's race. For that, we'll speak to one of the candidates later. But, it's heating up, John, and it goes into this economy. And I'll tell you, on my vaunted day off yesterday, I enjoyed the Whole Foods excursion.
Did you?
And everything's up.
The one on 3rd Avenue.
Every single.
Do you go to the one on 3rd?
No.
Was it 87, 88?
No,
What is
I crossed the park because I was talking to Elon on the phone.
You go to the Whole Foods on the Upper West Side?
Yeah, I go to the one that Abramowicz goes to.
Yeah.
Do you really?
97th Street.
Yeah, you know.
But Lisa lives near there. You don't.
Yeah. Well, no,
That
but
doesn't make sense.
I just go there. I just hang out.
I'm just reading e-commerce numbers. Did you hear about them, John?
Tell us about those e-commerce numbers.
I don't go downstairs, John.
Did you check out
John, I
Walmart's
don't go
e-commerce?
down
It's really
the
expanding
escalator.
rapidly.
You guys,
Like,
give me a break.
I just do the upstairs.
From New York City this morning, good morning.
I buy
Tom
cooking
Keene,
magazines.
Lisa Abramowicz, I'm Jonathan Ferro. I've had your cooking. It's not bad, actually.
It's good.
It's actually not bad.
He's really good.
He is. This is Bloomberg. From New York City for our audience worldwide, live on TV and radio, it's the price action this Tuesday. Your equity market with a lift, up 0.2% on the S&P 500, the Nasdaq advancing 0.5%, raising the outlook, the guidance over at Macy's, Home Depot, things better at Walmart. We'll go through those individual names in just a moment. Raising the outlook over at UBS, Keith Parker now looking for 4,400 on the S&P 500 from 4,250 and looking for a continued surprise for better profits in the year ahead. We'll touch on that a little bit later too. If we switch up the board, here are two sectors to watch through the year so far. Energy and financials. The banks up by more than 36% year to date. Energy stocks up by 43% year to date, and some people expected more gains in the year ahead. In the fund manager survey from Bank of America this morning, these two sectors, the biggest overweights for them since the spring of 2018. It's been almost 3 years. Their view, if you believe in the transitory story in that fund manager survey, switch up the board and get to the bond market. They believe you should lean into the long end of the 30-year. The 30-year Treasury at 236 right now. Yields basically unchanged on a session, 164 on 10s. If you believe in the transitory story, the trade coming from Bank of America, and I'll catch up with them a little bit later on this, is to lean into the 30s and lean into tech as well.
Huge gamble. I mean, it's a really bold statement, John.
But it's the contrarian view.
Yeah.
They're just putting it out there. If you agree that this is all transitory, then you should lean into it, lean the other way.
Yeah.
That's just them raising the point.
It's very transitory.
It's up to you if you want to characterize it as a gamble, Tom. Your words, not mine.
It's transitory.
It's transitory. You drink. Enjoy yourself, sir. Your bond market this morning, 164.20 on 10s. Romain Bostic has some movers for us this morning. Good morning, Romain.
Hey, good morning, John. Look, there was so much agita in this market about retailers. This idea that you had this pull forward, that you were going to have these tough comps, and these retailers just really weren't going to be able to sort of make those comps. But of course, they can rest a little bit easier, at least this morning here. Macy's up significantly here in the pre-market, up about 6%. Not only did you have net sales jumping more than 40% here, but you had gross margins expanded, inventory declining, SG&A expenses declining. That's sort of the cocktail that you want for a retailer. Of course, they're also raising their forecast, the bottom end of their forecast on a full year basis, now above the top end of what the street was looking for. That's on revenue, on adjusted EPS. It's way above what the street was looking for. Similar story here for Walmart. You had a 6% jump in comp sales. Street was looking for 2%. And of course, you had those online sales jumping about 30%, 37%, well above expectations here. So again, this idea that these companies were going to be hurt by these year-over-year comparisons, not really the case, at least for these two particular companies. We also had Home Depot report earnings as well. Similar story there. Not quite a retail story, but I want you to keep an eye on Amazon this morning, slightly higher in the pre-market, up about 0.7%. Of course, that report out of Variety last night saying that the company in talks to buy MGM movie studios. That would be about a $9 billion deal and would mark a huge shift for Amazon deeper into what presumably the streaming space, and I guess at some point just theatrical releases as well. Flip up the board. Tom, did you have a comment on that, Tom?
But I want to know where you are right now, Romain, with Comcast. I think, you know, the two that I'm watching for reaction to what we observed in the last 48 hours is Comcast in Philadelphia, the Roberts family, and also Disney out in Burbank, Glendale, wherever they're holding court today. Yeah. I can't fathom what they're going through right now, Romain.
Well, there's a couple of analysts we talked to on yesterday's show, Bloomberg Markets to Close, pretty much said, look, this is now about consolidation. You have a lot of streaming services out there, and this has sort of become a competition right now between Netflix and Disney Plus as far as number one, number two. Everyone else is basically competing for the middle of the pack. So do you want to be number 3, number 4, or number 10, or do you consolidate and maybe provide a little bit more competition for those? So it's not unlikely that you're going to see some people maybe come around, kick the tires of Peacock, NBC Universal, Viacom, CBS, Paramount, and some of these other streaming services. The question, though, is whether the CEOs of those companies are actually going to want to go down the consolidation path. Remember, some of those CEOs have been pretty adamant about their ability to stand on their own 2 feet. And of course, with some of the backlog and libraries that these companies have, a lot of them probably feel that they can maybe stand on their own 2 feet here. Tom, just real quickly, I just want to bring some attention to our viewers and our listeners going forward here. Keep an eye on the EV space. Joe Biden actually going to make a trip to a Rogue electric vehicle plant. That's a Ford plant in Michigan later today. A lot of the EV stocks are getting bid on this. Basically, this is just kind of a renewed commitment by the Biden administration to EVs. Yeah. Ford has already committed the money here. Tesla down here on word that Michael Berry, of course, of the Big Short fame, is now shorting Tesla stock. Maybe it's safe to short that stock again. Those shares down 1% in the pre-market. And also interesting story on the Bloomberg terminal about the Biden administration's recommitment to cybersecurity. A lot of cybersecurity stocks were a little bit higher here in the pre-market. Right now, FireEye only up about a tenth of a percent.
Romaine Bostick, thanks so much. It'll be an eventful to close this evening. I really can't say enough, folks, about Geetha Ranganathan at Bloomberg Intelligence. Her note on Comcast and an NBC Warner deal is blistering. That is must read for anyone with a Bloomberg terminal. Right now, over to economics. Pedrick Garvey joins us with ING, head of global debt and rate strategy. Pedrick, I love your research note of the idea of an explosion in inflation and then we ebb back. When we're at 4% inflation, what are we supposed to do?
You're not supposed to buy bonds, Tom, but that doesn't stop market participants from aggressively buying. I mean, one of the reasons that bond yields are where they are is because there is an excess of demand over supply, which is remarkable. This is a bear market for bonds. Bonds are down 3.5% so far this year. You throw in 4% inflation, which, by the way, is probably going to 5% before it comes back down again. And it is a real head scratcher as to why bonds are where they are. I mean, I think the only real rational answer is that it's just a number. It's a number that's in a way divorced from where the economy is, just reflecting those supply-demand factors.
Parag, this is the Goldman Sachs take right now on rates. Take profits on the bear steepener. US activity appears to be moving past the peak. The positive impulse to yields from growth is diminishing. Does that resonate with you at all?
Well, where I have an issue is in real yield space. It worries me. We are quite upbeat over the next couple of quarters. We think the economy does quite well. We think yields are far too low. Then again, if I look at where the 10-year is at minus 90 basis points, I mean, if I came down from Mars and saw that number and knew nothing else, I would say, man, what's going on here? Where are we going? There's a depression coming. So that worries me. There's a very negative discount coming from that pure standalone number. So I can see the rationale. I would disagree in the sense that we do think that this is not over, that there is a bear steepening trend still ahead of us. Still think 10s go to 2%.
2% on 10s. If we played Martian economics, though, at any point in the last decades, Parag, you know what would happen? We'd sit here and say, if I came down from Mars, this makes no sense. Can the Federal Reserve and central banks across the world keep it making no sense for a long time?
This is also a very different Fed, and it's a very different setup. What we have here is the official sector, government plus Fed, aggressively boosting this economy, and they're not going to let up. You listen to the Fed very carefully, and what they're saying is, we are going to stay where we are until the most vulnerable parts of the economy have recovered from COVID. That's going to take us quite some time. The official sector is in there as well, in the sense that we've effectively had helicopter money from the government financed by printing bills. It doesn't change until we get to a proper recovery. So, I mean, that combination as well makes it even more difficult to understand why yields are where they are. But they are where they are. And again, I mean, I can list off a number of reasons to why I think it's rationalized that they are where they are, but from a fundamental perspective, it makes no sense.
Parek, as we engage in the pendulum of Martian economics, I do want to just sort of put a bow on what you're saying. Is the reason why real yields are so negative, the most negative by some measures, or nearly about that since February, simply because of the Fed's asset purchases every month? It is their purchases that's tamping down the nominal yields, or is there some other dynamic at work internationally or otherwise that we ought to pay attention to?
There's a few things. The Fed is buying. U.S. pension funds are buying as well. They've been increasing their holdings of fixed income. We've had corporates set up fixed rate receivers, which means they receive fixed and pay floating to get ultra low funding. It's the same as buying bonds. If you look at FX adjusted positions, treasuries now have a 100 basis point pickup versus bonds and JGBs. You may say, well, that's the way it always is. Well, it isn't always that way when you FX adjust. So there's a number of factors out there which are boosting the demand side. I think my point is that some of these are transitory. We will move beyond them, and we will get to a point where fundamentals will have a greater say on where yields should be. Got to remember, you mentioned the 30-year at 2.3%. All that's doing is protecting you for inflation for the next 30 years. That's a 0% real yield. Is that a good investment? I don't think so.
So when do you see a trigger, Parek, in terms of making some of these yields a little more realistic in your view? Is it going to be taper talk from the Federal Reserve? Is it going to be actual inflation data?
Yeah, the taper talk story is a very nuanced one, because the moment the Fed starts to talk about tapering is the moment that they have accepted that the economy has absolutely recovered in a sense. So that could be a point in which the bond market could indeed start to take note. So we're of the opinion that that could start from the Humphrey Hawkins in August this year, and that Q4 this year could be the point when we have the uptick in yields.
Parek Garvey, always great to catch up with you, sir. Appreciate your insight and a little bit of pushback there against that 30-year trade too from ING, the head of global debt and rate strategy. Just getting some comments from the Prime Minister's spokesperson in the UK, Max Blaine, briefing reporters. The UK public should not travel to amber list countries. So we have this traffic light system now for travel, Tom. And on the green list, the places like Portugal, Gibraltar, the Ferro Islands. On the amber list, think of everything else across Europe. Don't go there seems to be the message from this government.
I mean, is Heathrow to JFK amber?
Heathrow to JFK, Tom. Look, if you're British and you're not a permanent resident in the United States of America, you can't get in.
You can't go.
You can't travel direct. You'd have to go somewhere else, stay there for 2 weeks, and then come across to the United States. We still haven't sorted this out ahead of the summer. And the airlines have been pressing, particularly over the last week, to say, look, guys, we need to get prepared. The president goes over to Europe next month, and there's a hope that perhaps he talks about opening things up again. But so far, I've seen very little on either side of the conversation.
This was buried in the news the last 2 days, John, but British Airways just saying, let's go. Yep. I don't get it. I'm lost on it.
I don't get it either. I mean, we've basically got a vaccine passport in New York. The Excelsior Pass, I mean, it's basically a vaccine passport. And no one wants to talk. No one, isn't that the story?
Don't say that.
You're not allowed to say that. It exists.
Does it, though?
It basically exists.
And actually, if you look at sort of the businesses, that's what they're doing.
Yeah.
Mets and Yankee Stadium.
Come on. 8:30 Eastern, a little bit later, Mark McCormick at TD Securities. I got some skin in the game here, so forgive me.
Where do you want to go?
I want to go home. From New York City this morning. Good morning. This is Bloomberg.
So does Harry Kane. He wants to go home.
With the first word news, I'm Rishka Gupta. The U.S. is now adding pressure to both sides to end the conflict in Gaza. President Biden has shifted his approach. He told Prime Minister Benjamin Netanyahu he'd support a ceasefire between Israel and Hamas. For days, the president had not publicly backed an end to the fighting. So far, at least 222 people have been killed, most of them in Gaza. Hamas militants have fired more than 3,100 rockets at Israel. Israel has responded with air raids and artillery. The U.S. Senate has voted to move ahead with a bill aimed at countering China's technology rise. The legislation is backed by both Democrats and Republicans. It would jumpstart research and development with a cash infusion of more than $100 billion. The bill could be passed by the end of the month. And the son of Rudy Giuliani is running for governor of New York. Andrew Giuliani tells the New York Post he's confident he can win next year's Republican primary and then defeat incumbent Governor Andrew Cuomo. Rudy Giuliani was mayor of New York and served as former President Trump's lawyer. Andrew Giuliani has never held public office. He spent 4 years in the Trump White House. And Lamborghini is the latest supercar maker to pivot to electric engines. Volkswagen's Italian brand says that by 2024 it will offer plug-in versions of each model of its lineup. Lamborghini also will launch its first vehicle powered purely by battery in the second half of the decade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We're going to be spending a lot more than Netflix. Right now, it's between the two of us, we're spending $20 billion a year on content, and we expect to spend more than that. Together, right now, we have almost 100 million subscribers, and neither one of us have really deployed aggressively outside the U.S., and we're differentiated in a meaningful way in the U.S. now with the extraordinary IP that John and his team have built together with Discovery. It's a very differentiated and compelling offering.
David Zaslav coming out swinging, the Discovery CEO from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. Here's your equity market this Tuesday. We're higher, up 8 points on the S&P. We advanced 0.2% in the bond market. Yields come in just a basis point to 163.69 in the FX market, 122.17. A series, 3 reports from retailers in America this morning. Home Depot, 1, a beat, nice. Raising a guidance 2, Macy's another, Walmart make it 3. The outlook looks brighter for retail in America.
I mean, the NBA speak floating around this week, John, is like, we don't need to stop the show.
Do you want to, it sounds like you've just done that, Lisa, so elaborate.
No, but Lisa's differentiated and compelling. I mean,
what did I do?
What does differentiated and we heard this from Mr. Zaslav of Discovery.
Oh, you're talking about the...
Okay, now I get what you're saying.
You're talking about the McKinsey speak.
Yes,
of
well
the likes
said.
Of Discovery.
Yes.
Tom,
exactly.
That's what you get every day. We get a tie-up like this. You get the McKinsey speak. You always get the McKinsey speak at these press conferences. What do you expect?
Okay, differentiated and compelling in this capacity.
Thanks. Lisa, don't translate.
I'm going to translate. Come on. Is reality TV meets HBO meets CNN.
Cool.
So, come on, John. I know you watch 90 Day Fiancé every time. 90 Day Fiancé is going to get along with Game of Thrones. You got to be kidding.
That's your favorite.
How much are you going to pay for it?
For 90 Day Fiancé, I pay $12 bucks a month.
To Michael Nathanson and Craig Moffat about this now for the last couple of weeks. I think a lot of people in this country and elsewhere are waking up, thinking about what they want to do with their summer, and when they look through the bill at the end of the month, wondering why they've got so many streaming services.
Yeah.
After last year it made sense. Does it make sense now?
I don't know. I mean, David Wilson's the expert on this. Let's go to him. He's focused on energy stock today, which David works because Steve Auth was talking $90 oil. I mean, you get out front of this for us.
Yeah, absolutely.
Because you're differentiated and compelling.
Well, I hope so, Tom. Okay. I mean, what can I say?
Differentiate $90 in oil and what it means for energy.
Well, what it means is something that Jonathan Krinsky pointed out in his latest note from Baycrest Partners. He's their chief market technician. And he had an interesting comparison. Call it dirty energy versus clean energy.
Yeah.
So what we're really talking about is a couple of exchange-traded funds. One of them is a spider that tracks oil and gas producers. The ticker is XOP. The other is a First Trust ETF for clean energy. The ticker there, QCLN.
It's done really well.
Yeah, right. Down 97% from its high in 2012 through last November. You've had a bit of a turn, though, and that's what's highlighted in green on the chart, is that the ratio has actually doubled from its low.
So, Dave, this is where we're on radio and you say, okay, it's tanked, it's been straight down, and finally we got a leg up.
Yeah, something like that.
Okay, continue.
And the point
I just wanted to be differentiating and compelling.
Pummeled, cratered,
you work on that,
crushed.
Tom. In any case,
come on, Tom,
Krinsky,
better worse than that. You've got it. Pummeled, cratered, crushed. Dave, Tom loves those words. Keep going.
Okay, fine. Let's put it this way. Krinsky is looking for more out of the old school energy stocks, the dirty energy, if you want to call it that, basically because, they have room to rebound. You can see how much room they have when you look at that chart, but as he figures it looks timely to get into those stocks. And certainly we have seen a reversal. And let's face it.
Guys, we got a judge here now. Was Dave differentiated and compelling?
Oh, dear Lord.
I think he was.
On what front?
I just thought he differentiated between clean and dirty oil there.
I think he's done really well. I think it was very compelling.
Dave differentiated and compelling.
Dave Wilson, thank you.
Yes,
on the energy sector. No idea what's happening this morning.
What's the surveillance ecosystem?
Got about 2 hours without talking about Gareth and Harry, so do you want to bring them in too? Give you a chance.
Well, yeah. I mean,
Harry?
come on. I can't focus, folks. Harry
clearly
Keene is with the tots here. And John, does he go to Manchester? Is that far enough away from London?
So
where
the star striker of your club in North London has put in a transfer request, reportedly, Tom.
Well, I don't think he's put it in yet. It's like
no idea.
On the cusp.
Some reports that he has informed the leaders of Tottenham that he wants to leave. Look, he's going to be looking at something north of 100 million to make that transfer. That's what Spurs could get. I think there's a few years left on his contract. He earns about 200k a week, sterling. That's going to get bumped up.
That's
whoever
like
buys
you.
him. I wish. That could go up to 250, 300. I don't know. What's really interesting right now is the big clubs clearly don't have much money in the way that they did several years back. The likes of Barcelona, Real Madrid.
You don't think they have the money for him?
Think about why we're in the position we're in right now over the last several weeks, the last several months, and why we're talking about a European Super League. Because these big clubs have spent an extraordinary amount of money buying players. I can think of Barcelona who have wasted 100, 150 mil on several players that just have not worked out. Coutinho, the Brazilian, being one. And going forward from here, I just wonder if they have the same cash to come out swinging and buy someone like Harry Kane, who's going to cost them north of 100 mil. So maybe it is a Manchester club.
The bottom line here is Harry Kane is differentiated and compelling.
He is compelling, and he is differentiated because he is one of the best strikers in world football right now.
It's a new paradigm.
Just a great goal scorer.
When do we hear paradigm? Maybe
I don't know if we're talking past each other. I've got no idea what we're doing now.
No, it's just all you nailed it, John. The McKinsey speak. I'm fed up. Look, I did a chart earlier today
Lisa
for
and I
radio.
yesterday said yesterday when we saw the word synergy that you'd get going.
Yeah.
That you'd be furious with it.
Come on. Look, we're talking here 40, 50. Tara LaChapelle's got it down to decimal point. 40, 50, $60 billion of loss. You got Leger and T-Mobile like a moonshot straight up.
Yep.
And AT&T, it looks like flat as a pancake at International House of Pancakes. Come on, this is a massive screw-up on the part of these guys.
Buying the assets wasn't enough. You've got to invest a ton of money to develop the content. Look, I thought that too yesterday, Tom, and then Bob Profusek came on from Jones Day, and do you know what he said?
What did he say?
He said, none of the criticism from the cheap seats. This market, this industry has moved really quickly in 5 years in a way that some people didn't anticipate.
That's fair.
Not my view. That was his.
That's fair, but I'm going to go to the McKinsey talk where it's differentiated in a paradigmatic shift towards synergy.
Synergy. Lisa, this is what gets me, and I think it bugs a lot of people. There was a time several years back when you cut the cord and you save money. I don't think you can say that anymore. An internet connection in America right now in New York City, what are you spending for cable, for broadband? $60, $70, $80 a month just for the broadband connection?
Yeah,
and then you've got to get all these services on top?
There's a reassessment of the bills, certainly, and also what media people are actually going to be looking for. I am wondering, though, what the reopening trade actually is. And I just want to dovetail away from streaming and into the retail numbers. I've been digging through. And actually, Macy's saw, for example, an increased demand in office clothes. Remember we were talking about a shortage in dress pants? They're talking about an increase in heels, et cetera. White teething. That was what Walmart saw a real boost in. White teething as people head back.
Teeth whitening, I think.
Teeth whitening.
I think teeth whitening.
Sorry, excuse me. I'm playing the transitory game. I honestly, I'm just saying it's interesting to see the reopening trade overwhelmed.
White teething flying off the shelves over in Macy's. Coming up, Chris Harvey of Wells Fargo Securities.
It's differentiated and
equity
compelling.
and strategy. That's this program. Differentiated.
This program is
somewhat
an ecosystem.
Compelling. With Tom Keene, Lisa Abramowicz, Jonathan Ferro on TV and radio. This is Bloomberg.
There's a lot of cash in the economy. There's a lot of cash on balance sheets, and this cash will get deployed one way or the other.
People, they don't like inflation. This is true, but they will tolerate it.
Inflation is going to be eating into the real wages of low-income households.
I think the risk of policy error is rising quite high.
Transitory gives the impression of over and done very quickly. I don't think that's what we'll see.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, a simulcast. Tons to talk about. We're going to touch on the markets here. Retail, huge earnings day today. You've got all the distractions of M&A. But I'm sorry, John, foreign exchange, it is speaking to the markets.
Yeah, dollar weaker, euro stronger, euro dollar with a 122 handle, and the dollar index breaking through 90, down through 90 to an 89. And this has been the trade people were waiting for, Tom, that the world would start to get better. We'd talk about synchronized global growth and the dollar would roll over. Didn't happen in Q1. Will it happen in Q2, into Q3, into Q4?
Part of the raging discussion we'll have today on whether, say, the euro at 122, does it go back to 119 or strengthen out to 125? And then, John, over in the yield space, I mean, I got an equity VIX under 20. That tells me good times ahead. But what does the real yield tell me now with a 5-year real yield going out near record negative?
10-year real yield, negative 92, 93 basis points. Lisa's been on top of this. For all the talk of a stable nominal yield, 164 on 10s, in and around 160, the average of the last couple of months or so.
Yeah.
Real yields have broken down again. They've rolled over. Just this idea that the Federal Reserve's going nowhere for a long time.
Lisa, what do you see there, particularly off Mr. Kaplan's comments? He's alone, but, well, maybe not for long.
Yeah, but he's really alone. I mean, the voting members are really not joining his tune at all. But I think it's interesting what Porrick Garvey said in the last hour of ING, basically saying the market's wrong and that real yields have to go higher here, especially given the fact that the Fed at some point will talk about tapering, which raises a question: how does the Fed gracefully extricate itself from markets? How do they do it with grace without disrupting everything?
They do it because they're differentiated and compelling. John, come on. The Fed can't do this gracefully. The market's going to speak.
It's going to be very difficult to do it gracefully. And I think the other thing they've tied themselves in knots over is they're telling us they're an outcome-based Fed. But they're also going to tell us, they'll warn us before they'll move well ahead of time. I'm not sure how you reconcile those two things.
I want to frame John right now off of Home Depot, particularly in the margin strength that we see there as well. His concept new in the last few weeks. Steve Oth brought it up on Surveillance earlier. He was differentiated and compelling about pricing power.
Yeah.
That seems to be a trend here into the end of the year.
There was a worry that maybe margins would come in a lot. Lumber's been going through the roof, and I think if margins are holding up in a world of rising prices, that means they're managing to pass that through to the end user, to the customer, Tom. Good news for the retailers so far.
Yeah, let me do the FX here right now, John. I want you to do bonds. 122.20 on euro dollar. That's really in a lone trade of euro strength, folks, against a weaker yen, relative against a weaker dollar as well. That blended index critically 91 down to 90, now ever lower, 89.77. An 88 print on DXY would be unimaginable. And John, it's confirmed on the Pacific Rim with stronger renminbi, almost out to recent records renminbi strength.
Yeah, EM doing nicely too, and it's the European proxies, the Euro proxies, the Eastern European countries, those currencies doing nicely. Poland, Hungary, just two of them this morning. Into the bond market, yields in about a basis point on 10s at 163.86 on a 10-year this morning. But I think the call of the morning so far, guys, it's got to be Mr. Steve Orth, the Federated, coming out, Lisa, and talking about a 90 handle. Tom, a 90 handle on WTI maybe later this year. That's his call, not ours. 66, 61 right now.
I think that the dynamic here is really compelling, especially with the shale producers being the marginal drillers that aren't necessarily going back as rapidly. You don't see them actually demonstrating the same willingness to expand. There is discipline. What does that mean in terms of supply possibly not returning to what it used to be, Tom?
I welcome all of you on radio and television worldwide. An eventful day. Looking at 9 o'clock. Geetha Ranganathan on these mergers with a note of the morning here on Comcast and what the Roberts family will do in Philadelphia. John, why don't you bring in our equity guest this morning who is compelling and is differentiated?
He very much is. It's Chris Harvey of Wells Fargo Securities, the head of equity strategy. Chris, I'll try and keep this on the rails for you, buddy. Does it get harder as we get closer and deeper into summer?
It does. So what we think as far as the market, you're going to have a pretty tight trading range. But again, what we always come back to is we think rates are going to go higher. You mentioned real rates. We think real rates, they're close to negative 100 basis points. You have generational GDP. You have a lot of other things going on. Eventually, they have to be forced higher. That's going to help the reinflation trade. And we're going to see a pretty big rotation, or a continuation of the rotation we've already seen. It hasn't ended, and it won't end for some time.
Where are you on the S&P right now, Chris? 3850, 3900 year end still?
Yep. So we're still lower. We've been too conservative. What we've been saying is you should see double-digit growth from financials, double-digit returns from financials, from small caps. But we're expecting mid-single-digit returns from larger caps. And we've been too conservative in that regard. The large caps have held up much better than we would have expected.
What's been the big concern here? Inflation? Or is it simply that there's so much of the returns have already been brought forward?
It's not so much inflation. It's just we thought the rotation would be even more aggressive than what it's been. And again, what's happened is the fundamentals for most companies have been quite good, but the fundamentals for the reinflation trade have been even better. So everything has risen. It's just one's a beta on the other, and the beta is higher than we expected.
Equity investors typically want more than single-digit returns, especially given what they've gotten accustomed to over the past few years. Where do they go?
So again, we like the financial space. We like a lot of the industrials, and what we want to do is we want to be more selective. We're looking for very good risk rewards, and it gets a lot more stock specific. And we're focusing more on companies that have good valuation but can really grow earnings, and you can find that across the board.
Chris, I want to go out a year. Right now, this new theme of pricing power is how does Wells Fargo select on an individual stock basis pricing power winners?
So we do lean on our fundamental analysts a lot for that. What we also do is we go through transcripts and we look at who's talking about pricing power. We are seeing pricing power in the chemical space, in the industrial space. Really, what you mentioned before, something that we have to say out loud is the consumer is a price taker at this point in time. They want what they want, and they want it now, and they're willing to pay. If they can't get it, they're willing to pay up for the next level, whether it's an Uber car, whether it's a washer dryer, what have you.
Well, this is a differentiated conversation about 2022's compelling pricing power. If that's the case, Chris, and no kidding aside, folks, does that mean you get sustained ratios because you have compelling pricing power?
For now, so we looked at margins, we looked at pricing power, we looked at volumes. And what we're seeing with corporations is they are bringing it to the bottom line. The consumer, the end buyer, is willing to pay up. They have the cash to do it. Demand is outstripping supply. And we think this continues for some time. As far as our expectation, what we would like to see is we'd like to see the bond market. We'd like to see rates lift a little bit, things cool off and extend the cycle. And we think if that does occur, this cycle can last a pretty long time.
There's lots of things we'd like to see, Chris, that would lead to a longer cycle. Are you making that cycle call right now, Chris? Is that the base case?
Well, what we're talking about is we do think that rates go higher. We do think that real rates have to push up, especially when you're looking at generational GDP. And if that does occur, things will go further. And the other thing that we're talking about that's changed from the beginning of the year is we're talking more about Europe. The vaccination, the EU had a difficult time distributing the vaccinations, but now the vaccinations are getting out. What we've seen from Israel, from the UK, from the US is once you get people vaccinated, things do improve, spending does improve. And that could extend the cycle as well. And we're starting to look for companies that can have more exposure or do have more exposure to the European market.
Chris, are you buying Bitcoin, or do you think that that's the most crowded trade, like the other fund managers surveyed by Bank of America in May?
I stay away from crypto. What I tell people is if you speculate and you're over 40, and I might be over 40, you speculate in gold. And if you're younger than 40, you speculate in crypto. So really not my space.
Chris, you're joking there, but I do wonder whether you've touched on something important. Do you think increasingly in years to come, we'll be conditioned in this market with the average investor as the average age starts to move towards a new generation? I just wonder from your perspective whether that's going to be the story. We'll be conditioned by what we've seen in the last year.
Well, I definitely think so. So go out and test it. So we've just done this anecdotally. I've looked at my two associates. One is over 40, one's under 40, one's buying gold, the other one's buying crypto. When you talk to people and you put this out there, you do see that. The younger generation is involved in crypto. They do believe in it, and it's their instrument of speculation, or appears to be their instrument of speculation. When you talk to people that are older, gold is that instrument of speculation. And we've seen this time and time again, but don't take my word for it. You know, talk to people when they come on the show, and I bet you we're about right.
Did you see that?
On
Chris,
radio,
you've got to leave it there.
On radio,
You've got to leave it there.
Ferro
Chris
is
Harvey
surreptitiously
of Wells Fargo.
dropping in promos. It's like,
where did
bring it up
where
again.
did that
Come on.
from? I don't know where that came from.
On
Where
radio,
did that promo come from?
Subliminal messaging.
There it is. For those of you on radio worldwide, Bloomberg Real Yield, Christopher Harvey, equity guy, joining John Friday at 1 p.m.
Thank you, Tom.
Thank you.
Thank you. I mean, I'm not responsible for that graphic. I don't know how it ended up in the rundown.
Who did you bribe?
I'm happy,
Come on.
I'm happy we're all on the same page here, that we're always thinking about Fridays at 1 p.m.
Okay, let's get back. You guys are irresponsible today. Joe Feldman seriously writing an important
Can I thank
note.
Chris quickly?
Chris,
Chris,
go away.
Chris, thank
Okay.
you.
Get
Gotta
ready
catch
for
up,
the
Chris.
Real
Thank
Yield
you.
on Friday.
Going to keep it on the rails.
Good way to keep it in.
Thank you.
Joe Feldman, Telsey Advisory Group, really important single sentence in his note is optimism on Home Depot. He says, John, they seem well stocked into 2021. That's not a small sentence. This is like a serious issue.
Well, this is the issue around lumber. Is that what you're touching on, Tom?
Yeah.
Yeah.
And all other commodities.
And margins holding up as well, Lisa, and the outlook looks better. For these retailers this morning, I think it's been really impressive for a range of retailers, to Macy's, to Walmart, to Home Depot.
And frankly, this does put the focus on that savings glut that people are talking about. People have money to spend. They are spending it. Will they keep spending it on stuff as experiences start to open up again? Because, yes, they have to some degree, but not completely.
Equity futures this morning up about 10 points on the S&P. We advance about 1/4%. Have I ever told you about a program at 1 p.m. Eastern?
Did you?
On
Really?
Fridays.
That's good.
Coming up.
Negative
a bit
yields?
later this week. Bloomberg.
Negative
Real yield.
0.94%
Well, you two
on
have
the
already
Real
gone
Yield.
home. Some of us are working a full day.
Catchy.
On Fridays going into the weekend. On the bond
I'll be
market, 30
lunching.
minutes dedicated to fixed income with prime investors around the world on the dominant asset class.
Look at you.
Thank you. This
Love
is
it.
Bloomberg.
That was different.
With the First Word News, I'm Ritika Gupta. The CEO of Walmart says Americans want to get out and shop. The world's largest retailer was just one of the U.S. chains to report strong quarterly results today. Walmart also boosted its profit outlook. So did Macy's. The department store chain also posted first quarter sales that were better than expected. And Home Depot's results indicated that the home improvement trend has room to run. Same-store sales in the U.S. rose almost 30%. Republican senators plan today to deliver their counteroffer to President Biden's infrastructure plan. The president has called for spending a little more than $2.2 trillion. Senator Lindsey Graham says the GOP proposal could be as high as $900 billion. Republicans are opposed to using tax hikes to pay for the spending. And the Biden administration has now shifted its approach to the violence in Gaza. President Biden told Prime Minister Benjamin Netanyahu he'd support a ceasefire between Israel and Hamas. For days, the president had publicly called for calm, but not for an end to the conflict. Since last week, Hamas militants have fired more than 3,100 rockets into Israel, whilst Israel has pummeled Gaza with air raids and artillery. Investor Michael Burry made billions betting against mortgage securities during the financial crisis. It was a feat immortalized in the book and the movie The Big Short. Now, Burry has placed a sizable bet against Elon Musk's Tesla. His asset management firm has bearish puts on more than 800,000 shares of Tesla. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I see the dynamics of why you'd want to get bigger in this space. Media assets have done extraordinarily well relative to trend because of all the COVID lockdowns. There may be the new energy companies, pouring billions of dollars into the ground. They're talking about $20 billion of investment over there at AT&T Time Warner. That's a lot of money going into content, and there's an awful lot of content out there.
Steve Author of Federated Hermes, David Zaslav, the Discovery CEO, saying yesterday, right now, between the two of us, we're spending $20 billion a year on content, and we expect to spend more than that. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro, counting you down to the opening bell in about an hour. Your equity market up to 41.66, up by 8 or 9 points on the S&P. We advanced 0.2% into the bond market. Yields come in a basis point to 163.69. The dollar erasing the gains of the year, now negative for 2021. Euro dollar 122.20, up 0.5%. The dollar index, Tom, 89.76.
Watching DXY under a 90, and also the VIX comes in even stronger from 20 down to a more bullish 19.64. This is a joy to be with Paul Sweeney. Of course, 9 o'clock will be on radio at Worldwide. I've anticipated that for the last 24 hours because he is truly expert on this insanity of our media business. Paul Sweeney's career goes back a zillion years. Think Gandhi in 1982, where he wandered in as an intern at some sell side onto Credit Suisse, and it is he that built Bloomberg Intelligence. Paul, thrilled to have you with us today. Let me cut to the chase right now. How does the Roberts family respond to this, and how does the Iger less Disney respond to this?
Yeah, I think the big next deal to happen, Tom, is going to involve NBC Universal, part of Comcast, and Viacom CBS. Those are two
How does NBC buy CBS?
I don't know. I think maybe they spin out their NBC Universal business into a separate company and merge that into Viacom CBS, similar to what we just saw with AT&T and Discovery, and that would, in fact, create a formidable player, more competitive with what we're seeing out there.
I believe the AT&T breakup fee is $700 million. The DirecTV one is $1.x billion, whatever. That sounds like a rounding error to me to get this done. Why can't the Roberts family go after Warner, which is what they really wanted to do all along? Geetha Ranganathan, who's better than you, writing this up at Bloomberg Intelligence.
Yeah, absolutely. This is kind of, one could argue, the last round of consolidation for these really big media companies. After this, you get to some subscale media companies. So if, in fact, Comcast wants to really double down on their content,
they got to go after Warner Brothers.
They have to go after either Warner Brothers or, again, maybe spin out their NBC Universal and merge that with Viacom CBS.
Paul, what's the big risk here? Because we are seeing a record pace of merger tie-ups here, and it comes on the heels of a very unusual year, a very unusual amount of appetite for streaming services. What's the risk that we may be overvaluing some of the content?
Yeah, I think the risk really is in execution. It's, there's to be a global streaming company, that's a new business. Netflix created the global media company. It never really existed before. So Netflix has taken its content all around the world. That has to be the model because these companies, again, as we just reported, are spending $20 billion a year and growing on content. That's an investment they make on a yearly basis. And so in order to generate a return on that business, you have to be successful from a subscriber perspective on a global scale. Netflix has done it. The market is betting that the Walt Disney Company can do it. The question is now, can David Zaslav, with these new assets, also be successful on a global scale? I believe he can be. Discovery is, prior to this round of consolidation, the most global media company that we have out there. They've been in the international markets for a long time, competing very successfully. The question becomes then, what happens to Comcast? What happens to Viacom, CBS, as well as some of these smaller companies?
And also, what happens with the consumer that's paying for each individual streaming service here? And I know John's talked a lot about this idea of at what point do people start to cut some of their subscriptions? At what point also are we talking about bundling? About some sort of package deal, perhaps akin to Back to the Future cable.
Right, exactly. Yeah, that's kind of the key issue here that we really don't know, which is how many streaming services do people really want to pay for? Is it 3? Is it 4? Is it 5? But the reality is it's not going to be more than that, most likely. So if you're not one of the top 3, maybe 4, that's going to be a struggle.
We need to differentiate and be compelling here. I've got to go to my colleague, John Farrell. John, I am riveted on 90 Day Fiance by Brandon and Julia. I find Brandon and Julia just to be the most interesting couple on 90 Day Fiance. John, how's that going to...
Which couple are they?
They're like, they're like really trying to stay together, unlike the rest of those trends.
Which couple's the one that went to Ecuador? Was that program?
No, that wasn't Brandon and Julia.
Who was that?
I don't know, John. You're my Love Island 90 Day Fiance expert.
That's ITV.
Can you see 90 Day Fiance dovetailed with HBO Max Game of Thrones stuff? I can see a lot of those things doing okay, Tom. You and I both watch a bit of trash now and then. The thing that I struggle with, Paul, is right now the consumer. I don't think the consumer's winning. I think for a long time we've been told the consumer's winning because TV's never been so good. Content production is fantastic. But right now, when you look at your bill,
it must be close to $200 for most people now, Paul, who are looking at, let's go through it. Let's go through it in New York City. So you're looking at $60, $70 conservatively for an okay broadband connection. On top of that, if you wanted live TV, what does Hulu cost now, Tom? 50, 60 bucks? And I know, Tom, that you cancelled YouTube Live, the TV version of YouTube too, because that was $60 a month.
Nobody was using it.
Add it all up, Paul, you're getting close to $200 for a lot of people. Now, $200, that is a lot of money, a tremendous amount of money. And when you wake up at the end of the month and you're starting to think about doing different things because you're allowed outside, I don't know if you want to spend that kind of money on a TV service, do you?
Yeah, that's a great point. And, you know, what I think we found really over the past 14 months of this pandemic is what was likely to be 2 or 3 years of a sampling among consumers of all the various streaming services that are out there, and seemingly every media company today does have a streaming service. That sampling time frame was consolidated into maybe 12 to 14 months here, and we're starting to see some shakeout here. So, you know, if you think back to maybe that cable bundle that we had for the last 20 or 30 years wasn't so bad. I paid $100, maybe $120 a month, and I got 500 channels plus the broadband. So that's why I think a lot of folks believe that there's going to be a shakeout of these streaming services. And in fact, you're not going to be paying for 6, 7, 8 of these things. It's going to really winnow down to the 2 or 3, maybe 4 leaders, and that's about it.
That's
and
it.
so, you know, and who's going to be left standing?
Yep, Paul Sweeney of Bloomberg will be on Bloomberg Radio with Tom Keene in about 35 minutes from now.
Really
and
differentiating
I'm totally,
him,
you know
Bill.
what, Tom, I'm totally with Paul on this. I really am. I don't think people can afford to keep that up. That is too much money.
It's too much
just
money.
Way too much money.
Sarah over at Axios had it at $40 a month. I mean, it's, you know, for a huge body of the public, it's 4 services and $40 a month for combined.
Yeah, and then you throw broadband into the top of it, and Lisa, the numbers add up really, really quickly.
Yeah, and when people can actually go out into the world. My 9-year-old said to me, I'm sick of screens. And it was sort of this epiphany.
Yep.
The pandemic has actually made kids not want to be on devices anymore, at least some of them.
For now, at least.
For now.
It'd be nice to see
Give
them
them a week.
playing football again and off the video games.
We got through Sweeney without any McKinsey speak.
No McKinsey speak with Paul
It was great.
For good reason. Mark McCormick at TD joining us very shortly on Bloomberg TV and radio, on Bloomberg Surveillance, with your dollar the weakest we've seen it through the year so far, or at least taking out the gains of the year so far, negative for 2021 to be more precise. This is Bloomberg. From New York City for our audience worldwide, good morning to you all. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. On TV, on radio, some economic data in America. With that data for you, here's Mike McKee.
Oh, good morning, John. We're looking for housing starts this morning. Mortgage rates very low because of the Fed, and we've seen some rebound in the construction activity as the weather gets warmer. It does take a little bit longer to get data these days because they no longer do the lockups, but we'll see as soon as the Commerce Department drops the housing starts numbers what they turn out to be. The forecast is for 1,704,000 annual rate. That would be a decline of 2% from the month of April, but April was a big rebound. March was a big rebound from February when the weather was terrible. So far, no numbers out,
What's
Tom.
the price? What's the price dynamics right now, Michael McKee?
The price of?
Price of, you know, we get price data out with these statistics as well.
Yeah.
The price is to the moon. I saw in California, I think it was, the average house is $800,000. That's, you know, stunning.
It makes a difference, and costs are rising for builders, but they are building more homes. It looks like 1,760,000 is the. That's building permits. Housing starts 1,569,000, so that is significantly lower than the original. The number in March, which was 1,739,000. It's a 9.5% decline on the month. The number of building permits, 1,760,000 annual rate. That's better than the number we saw in March, 1,700,000. 5.9. So it looks like builders had to cut back for a little bit. We don't really have a reasoning on that that I can see yet. Weather was reasonably good.
Raw materials, labor cost, finding the people to hire. What is it?
A little bit of that, all of that. We have seen a labor shortage in the construction industry. A lot of people went into construction, and yet they can't keep up with that. I don't think costs are as big a problem because they can be passed along, but land, I understand, has been hard for people to get a hold of. Well, so it's been a bit of an issue there.
Mike, there's also been a concern here that the demand is so far outstripping supply that builders cannot build quickly enough, which is the reason why we've seen the incredible surge in lumber prices. Is there any concern about overbuilding, about the froth in this market that could end up leading to some problematic consequences down the line?
Not at this point, Lisa. The number of new homes under construction is not meeting demand yet, and that's the problem they have in the housing market that is also pushing up some prices, especially in some areas where affordable housing is hard to get, San Francisco being a particular model of that. So until we see the number of people looking for homes decline, and we saw the home builders survey yesterday say that's not really an issue. We're seeing a lot of traffic. They're going to have to keep building, and we'll see what happens with family formation and the fact that people who moved in with their parents during the crisis now want to move out and get their own place.
They better want to. Michael McKee, thank you so much. Greatly appreciate that.
Mike, thanks.
I can't concentrate now. Michael McKee, thank you so much.
I hope your children aren't watching, Tom.
Who do you want to move out?
Yeah, well, all of them. Vet bill can stay. Right now on foreign exchange, we have anticipated this because he has been more brilliant than anyone I know on saying weak dollar, when's it going to happen? We're not sure. Mark McCormick is with TD Securities. Mark, the dollar finally breaks down. Is it enough of a break for you to switch to a bit of a weak dollar?
Well, yeah, I think we still like the medium-term dollar down story. I think there's an interesting element where the global economy is doing pretty good. It's catching up with the United States. We do see absolute growth levels that are favoring the U.S., but the delta of growth, which matters for currencies, is moving in a weaker dollar direction. The most important factor is really, again, the Fed is allowing the weakness in the dollar essentially because what they're trying to do is run the economy hot, let inflation run higher, and they're experimenting with what feels like an MMT-type narrative. So you add those things together, and the dollar's still overvalued, and we're still seeing, again, the global story is moving the right direction. So those are ingredients for a medium-term dollar move lower. But I think the more interesting action is really on the kind of the month-to-month, the 3-month, the quarterly basis, which is really giving us really interesting pivot points to make tactical decisions whether or not you want to overweight or underweight currencies against the dollar in that timeline.
So, Mark, we're trying to resolve a tug of war, the tension, as you've pointed out, between global reflation, a global synchronized recovery, and U.S. exceptionalism. Between that tug of war right now, Mark, what do you think wins out?
Yeah, I think right now we kind of have to downgrade global reflation a little bit. It's not really about U.S. exceptionalism, but I think what we had is obviously weak NFP print and really strong inflation numbers. I think what we've learned from a lot of conversations with clients is people are completely mixed. It's one or the other. It's binary. Either the Fed is making a huge mistake and they're going to have to, really work to make things better, or they fall on our side, which is basically they're not going to taper anytime soon and they're not going to hike rates until about 2024. But there's definitely a debate that is very lively that the Fed could taper or start talking about tapering in June, July, or even at Jackson Hole in August. So that's live. And I think in that environment, what we're seeing is reflation is starting to move a little bit lower based on the mobility that we track on a daily basis. Volatility should be higher. Inflation break even should be a little bit lower, and real rates should be a little bit higher. So in that backdrop, that's a little bit more positive for the dollar, at least on a tactical basis versus kind of the medium-term outlook we just outlined.
But so, Mark, let's push this through euro-dollar right now. High of the year on euro-dollar, 123.49, intraday high back on January 6th. Where are you looking to push this through and when? 123, right now 122.23. What are you looking for on euro-dollar?
I think these are good fade levels. So if you're to take our
right here.
if you were to take our year-ahead forecast, we're in a 122 to 118 camp. So even at the end of the year, I think we're going to see a little bit more of a stronger dollar versus the euro. Again, I think most of the action FX is really going to come down to factors that aren't really related or a big driver of the euro, which is really commodity exposure, value, relative economic growth, and even the equity story. I think the upside for the euro that people aren't expecting isn't going to be a central bank trade. It's going to be an equity story. So if European equities start to outperform like they have been, or at least on the daily tracking of ETF flows, that's where I think people could be surprised by the euro. But based on the growth, the carry, the value, and the relative central bank policy, to me, euro still a sell at 122, and you buy it back around 118, 117.
So what could be the trigger for what you're saying, for the money flooding into European equities and driving euro higher? What data points are you looking at?
I think it comes down to the growth in the vaccine catch-up story. That is a big narrative now that I think is important. But I think the problem is there isn't enough on the other side to say there's a bunch of factors we want to buy the euro on. But if the vaccine story and the growth delta are important, but we don't see the valuation story there. We don't see the carry argument. We don't see the yield curve steepness. So there's a couple elements there. And obviously commodities is not a big driver of the euro. And that's why you kind of want to look elsewhere in Europe. Again, like the Norwegian krone, you've got a hawkish central bank, you've got commodity, you've got global connections. So I think with the euro, what you would kind of need to see it's already there in the price. Most of our models say the euro is a little bit overdone, and that's why I'm a little wary of chasing it, because you don't have a value story along with a very stellar growth story. You have a pickup story, which is interesting, but it's really well known by the market. So again, I think for the equity story to work out is we really need to see what happens with the German elections later this year. If we do get a pivot to a green-led movement, kind of center-left, I think MMT narrative is much better for Europe because it brings capital back into Europe. No more recycling of the current account surplus, and that would be beneficial for the euro. Versus the MMT narrative is not as great for the U.S. because you're taxing, where the marginal driver of innovation comes in the U.S., which is the equity market, which is what the dollar needs this cycle.
Okay, just to parse through some of this and dig into a lot of what you're saying, and this is going back to the question of, is fiscal spending good or bad for a currency? And you're saying that fiscal spending in Europe could be good, whereas fiscal spending in the U.S. could be bad for the dollar with respect to its strength because of the taxation that's likely to accompany it. Am I getting that correctly?
Absolutely. I think it's very critical. One of the things that is most heavily missed, and I'd say even especially the last 5 years, the relative equity story is absolutely critical. If you think about why the dollar was able to rally during the Trump years, a lot of it had to do with U.S. equities outperformed the rest of the world, and the U.S. yield curve was steepening while the rest of the world yield curve was flattening. For the dollar to really kind of make up what is, I think, a weak dollar policy from the Fed, it is going to need equity flows. So in a broad balance of payments context, you're going to have a twin deficit, which does need an offset. The twin deficit during the Trump years was offset by equity inflows and the growth story. So I think a big side of it here is if European policymakers deliver more positive growth shocks, especially, again, with the German elections, maybe leading to more fiscal stimulus, that's an important development because that gives people a reason to bring capital flows back into Europe, where they've been recycling them out of Europe for the past 10 years. So that's where I do think it's critical. And if the U.S. were to tax equity markets and tax the wealth and innovation that comes from the equity markets, that's a negative for the dollar in the context of where the Fed's going and the global economy is. That's why, again, we like it lower over the medium term.
Mark, always smart. Good to see you. Mark McCormick there of TD Securities, the global head of FX strategy. Euro dollar today with a 122 handle. Plenty of reaction from the south side on retail earnings so far this morning. Home Depot, Walmart, Macy's all raising their outlook, their guidance for the full year. Guggenheim, Stephen Forbes saying the following, Tom. Importantly, not only was gross margin relatively stable year over year in the face of significant lumber inflation, but the company generated a relatively high incremental margin on the top line beat, showcasing solid expense control. Just one of the takes from the south side this morning on a better Home Depot. That stock up by 2%.
Yeah, Zaccone over at Citigroup with 375 price target up 17%. He reaffirms a very optimistic view there from 326 up to 375 as well. John, I think the dynamics now are just absolutely fascinating, particularly in the real yield, negative 0.94%. I don't think a lot of people expected that.
What did you make of pushing back against this move we're seeing in euro dollar from Mark McCormick? He'd fade it here.
Well,
he'd push back.
Everybody's got an opinion. I'm looking at stronger euro dollar over the last 3 hours. And again, this has to do with relative rate dynamics versus flows. And McCormick always goes back to equity flows into
and then the politics on
US,
top of that.
You see it.
The politics on top of that. Germany maybe, Lisa, turning green. That could be a huge political shift. in Germany.
But remember, we were talking a couple months ago about whether fiscal stimulus was good or bad for currencies, and people were all over the map on this. And the fact that Mark McCormick was coming out and saying that a green policy in Germany could be beneficial for the euro, whereas what's going on in the U.S. with taxation, not so much, I find that fascinating.
We'll continue this conversation
We will.
on Bloomberg TV. Lisa's going to be watching Secretary Yellen.
Actually,
I'll be speaking to Morgan Stanley's chief U.S.
I saw
equity
her
strategist, Mike Wilson.
Watch you.
From New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Good to have you all back together in the same room, almost, with a window separating us still. Why haven't we got this done? Are we getting this done? We're getting this is certainly differentiated.
It's compelling.
From New York. This is Bloomberg.
Our ecosystem.
With the First Word News, I'm Ritika Gupta. The U.S. is now adding pressure to both sides to end the conflict in Gaza. President Biden has shifted his approach. He told Prime Minister Benjamin Netanyahu he'd support a ceasefire between Israel and Hamas. For days, the president had not publicly backed an end to the fighting. So far, at least 222 people have been killed, most of them in Gaza. Hamas militants have fired more than 3,100 rockets at Israel. Israel has responded with air raids and artillery. The U.S. Senate has voted to move ahead with a bill aimed at countering China's rise in technology. The legislation is backed by both Democrats and Republicans. It would jumpstart research and development with a cash infusion of more than $100 billion. The bill could be passed by the end of the month. And the son of Rudy Giuliani is running for governor of New York. Andrew Giuliani tells the New York Post he's confident he can win next year's Republican primary and then defeat incumbent Governor Andrew Cuomo. Rudy Giuliani was mayor of New York and served as former President Trump's lawyer. Andrew Giuliani has never held public office. He spent 4 years in the Trump White House. Fidelity is looking to attract the next generation of investors. The firm is unveiling a new type of account aimed at 13 to 17-year-olds. It will allow them to save, spend, and invest their money. Teenagers will be able to make their own trades on Fidelity's mobile app with zero account fees. Still, they will have to have a parent or guardian who also invests with the firm. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Good morning, everyone. Bloomberg Surveillance, Lisa Abramowicz and Tom Keene. John prepares for an eventful 9 o'clock hour. Paul Sweeney and I will have Michael Nathanson and Craig Moffett with us on the media mergers. We're thrilled to begin the 9 o'clock hour on Bloomberg Radio Worldwide with Moffett and Nathanson. Right now, an exceptionally important conversation with one of the candidates for that June 22nd primary in New York City. Eric Adams joins us with just an absolutely remarkable biography. Eric, you're lining up the endorsements. You are on a dash to June 22nd. What is the endorsement? What is the support you most covet right now?
Really, everyday people. I like to say those blue-collar workers, not only those employees who are doing the construction and other jobs, but even my accountants, my doctors. It's a symbol of blue-collarism, I like to say. Hard-working people in the city of New York, and they really have endorsed my campaign because they know I protected the city for 22 years. And public safety is the prerequisite to prosperity, and that's the symbol I'm going to bring.
And it's the way you got to that 22-year career. We're not going to go into it right now because of time, but you had a most original path to serving with the NYPD. Tell us right now how the NYPD can change with Mayor Adams.
It's about rebuilding trust. I will state this over and over again, and many of my colleagues that are running for office don't want to talk about this. We have to rebuild the trust, change the ecosystem of public safety, define the role of police, but most importantly, we need each other. Let me tell you something. The streets of our country in general, but specifically in New York, those streets are going to be controlled by the good guys or the bad guys. And I'll be darned if I'm going to let the bad guys take us back to the days when we were having 2,000 homicides a year. I'm going to rebuild trust with law enforcement and communities in this city.
Eric, this is an incredibly important message at a time when shootings were up 166% year over year in April in New York City. When people are wondering, how do you accomplish what you're looking for, which is safer streets and preventing some of these shootings and other violent crimes from getting out of control? What's your recommendation as a 22-year veteran of the New York Police Department? Do you recommend putting plainclothes police officers in subways? What measures specifically are needed?
Well, there are a number of things we must look at. And dealing with this crime problem is both prevention and intervention. Prevention, that consists of the long-term things we must do. But intervention is right now. We have 3-year-olds shot at Times Square. We had a number of homicides and shootings in the last few days. So it's about reinstituting an anti-gun unit that is better trained, will have officers that are using their cameras properly, and will do what's called precision policing. We must go after the gangs and the overproliferation of guns in our city. If we don't, we are not going to have an economic recovery. We won't have the tourism, the business travelers, or get our offices back up and operating.
Eric, this is what a lot of people are saying, that if you don't have safe streets, you can't get businesses that already are thinking of leaving to stay in this city. What other measures are you going to take to keep them here, especially given the fact that the bills for all of these services and all of these measures are racking up, and there's a deficit that we need to address as well?
Yes, and there's also a great opportunity. Number one, thanks to our Senate and congressional delegation, we're going to have over $10 billion in stimulus coming to our city. But the real question is, are we going to squander this opportunity? We have to end the inequalities that we see in this city. And it's really because all of our cities in America are just really dysfunctional. Cities are made up of agencies. If those agencies are not aligned, you're not going to get the results that you're looking for. So we must attract new businesses here, become the center of cybersecurity, of technology, of self-driving cars. We are too expensive, too bureaucratic, and too difficult to do business in the city. And I'm going to turn that around.
Eric Adams, I am really upset about your endorsement from Doc Gooden. I don't know how I can do that. I need you to get an endorsement from Ellis Burks of the Boston Red Sox. Let's get on that today. How are you going to bring together New York? Everybody's polarized. There's I think there's 400 candidates, Lisa. But Mayor Adams, how are you going to bring New York together? The fancy people, the less fancy people. How do you do that day one?
Well, first of all, we're going to send out the right message. Listen, 65,000 New Yorkers are paying 51% of our income taxes. They are only 2% of our income tax filers. I don't join the chorus that states, so what if they leave? No, we need them here.
How are you going to keep them here? What's your policy going to be to keep the upper 1% happy in New York City so they don't move down to watch the Florida Marlins?
Well, one thing's for sure. Let me tell you, I hear from them all the time. Eric, we don't feel safe.
Yeah.
Eric, we don't believe we can walk our streets and our community. We can't use our transit system in a safe way. All New Yorkers, no matter if you are a cab driver or a person that's in the back of a limousine, you want a safe city. And that is something I know far too well of what an unsafe city can do to the economic environment and the stability of the city. And I'm going to make this city a safe place to raise healthy children and families.
Eric, just before we let you go, this is a delicate issue. The New York Times had a story that I want to give you a chance to address, where they were talking about some contributions that you've taken from businesses that the city has influence on and you have influence on as borough president. You've called money the enemy of politics before. Do you have a response to this story?
Yes, and it's not a delicate issue for me. No issue is delicate for me because I am extremely transparent. I'm one of the few elected officials in the country that has a procurement, or I should say a compliance officer that's on board with me. This story has been vetted so many times. I was surprised to see the New York Times place this on their first page above the fold to give the appearance that any improprieties took place. This has been vetted. We are clear compliance with all the rules. And I was really disappointed by that headline that gave the appearance of any wrongdoings. We have not received any type of infractions based on how we handle our procedures at Borough Hall. I am not impacted by money and politics. I'm impacted by what's needed for everyday New Yorkers and Brooklynites, and I have done that for over 35 years.
Eric Adams, thank you so much. He's a mayoral candidate, the June 22nd primary vote here in New York City. Lisa, the news flow, truly extraordinary.
Yeah, and really underpinning it is a high degree of uncertainty that this time is different, but nobody wants to say that. This time is different with inflation. This time is different when it comes to corporate profits. This time is different as to where we are in the cycle, which is a huge debate. And this, to me, is one of the key issues as we head into the second half of the year, because evidently, as you said, we're already at mid-year.
Well, we're already at mid-year. That's what Andrew Sheets said over at Morgan Stanley. We've got Abby Joseph Cohen coming up again. Moffett Nathanson, I believe, scheduled over on Bloomberg Radio. Lisa, you got a panel today?
Yeah, we're going to be talking on Emma Live. We're going to be Jack Farchi and John Authors and myself talking about inflation and the Federal Reserve.
Very good. We continue forward, an eventful morning as well on radio and television. This is Bloomberg. Good morning.